answer within the fiction that is their economics. The issue here is Beijing is going to come to the rescue, and what form will they come to the rescue, and whatever. The answer is there's deflation in order, and do they inflate their way out of it? That's the short answer, and history says they will do it. They will have to act to provide societal stability.
Europe would like to see that as well. Their data is problematic, let's put it that way. It's a return to growth, but inflation is still an issue. Second quarter GDP advancing by 0.3% after shrinking and stagnating in the previous two periods. That pretty much sums up the backdrop for growth in the Eurozone at the moment. And then core CPI, Bramo, for July coming in a touch above estimates of 5.5%. And a team at Bloomberg pointing out that core CPI surpassing headline inflation for the first time since 2021. President Lagarde, Bramo, can't get a break.
Especially given the fact that energy prices have been inflecting upwards. So if you're getting a big boost from the fact that energy prices have come down or been low, that could change at a time where the underlying wages and other forces are really pushing things upwards. So at what point does the ECB reverse some of the dovish tone and really lean into rate hikes? Christine Lagarde over the weekend saying that a pause isn't just a pause, that they could then go again and basically doing a J Powell.
All this is under surveillance. I think it's great economics around the world, and that, to me, the only thing under surveillance here is Kane has got one foot in Germany this morning.
Bayern Munich, the meeting happens today.
It's like they're arguing about value, right?
So Daniel Levy, who runs the club,
yeah,
I understand, TK,
there seemed to be
was meant
some
to have
pressures.
a meeting going into the weekend, then the meeting got scheduled, and they meet again today with Bayern Munich, the German football powerhouse.
Is that the same quality of
Harry
league?
goes.
Is the German league as difficult, as challenging as the Premier League?
No, I wouldn't say it is. I would say that the Premier League is the elite of European football right now, given the players and the teams that they've got. But Bayern Munich is incredibly competitive in the Champions League in a way that Harry Kane would like Tottenham to be, but they're not. And that's the issue. And I think if he's going to leave Spurs, TK, you'd think he would go to a club like that instead of a crosstown rival, where he would be hated by Spurs fans for going to, say, a Chelsea, or going up to somewhere like Manchester.
Or Liverpool.
Or Liverpool or something like that. But we'll see what happens, Tom.
He's
getting older. This is his last big chance of getting a major contract.
And you look at the mess of Tottenham right now. I mean, you can understand probably Adele will root for Barron as well. Right now, on what we've done under surveillance, looking here particularly at the Pacific Rim, Carl Weinberg joins us. He's chief economist at High Frequency Economics, but far more than that, is steeped in financial crisis on an international basis. And his notes on China and Japan have been absolutely definitive. Carl Weinberg, why hasn't the yen moved abruptly off of the verbiage and action of the Bank of Japan?
Hi, good morning, Tom. Good morning, John. Good morning, Lisa. You know, the currency isn't going to move on a dime. They only moved on Friday. And this change in policy sets off different forces in the economy. It's not just about interest rate differentials. But if you're an investor in Japan and you're looking to deploy marginal funds, you're looking at almost an assured loss on long-term JGBs right now. And if you need to have long-term assets to offset long-term liabilities, you have to look abroad. So to a certain extent, this tightening of monetary conditions, or the allowance of bond yields to rise, whatever you want to call it, drives money abroad and makes the yen cheaper, which is not what your traditional interest rate theory says it ought to do in the terms of the currency. But I think we have to expect a really mixed pattern for the yen moving forward from here.
What's your scope and scale on yen move? I mean, I know you're not in the business of FX analysis, but are you looking 150 yen or 132 yen?
Well, I'm not going to take a long-term position on that because I still don't know what the Bank of Japan is up to entirely. I mean, we saw this widening of the band. Was this a technical adjustment just to allow more trading both ways in the bond market and to improve trading conditions for people who have to be in the market? Or was it the first step in an actual tightening of monetary conditions? It's not at all clear. As Lisa pointed out, we did the calculations that show that if we had the bond market fully adjust to the increase in the band, that the hit to portfolios economy-wide would be about 4.5% of GDP. That was our math. And right now we have a huge profit on the Nikkei that if we were to call the end of the fiscal year today and all those bond yield all of that bond yield headroom were used, we'd see kind of a wash between gains on equities and losses on bonds. That's a one-shot deal, and I think that Ueda-san is hoping to take advantage of that, hoping that the stock market will continue its rally and offset losses on the bond market and give him this little step toward normalization. But if that's it, if it's half a percentage point and that's it, then there's no impact on the yen whatsoever beyond the next couple of weeks, and there's no basis to look for a major move.
We were also talking about China and how much willingness there will be by the People's Bank of China and just in general from authorities to support an economy that's flirting with deflation, outright deflation. Do you think that they can come in with something that can avoid more protracted deflation over a sustained period of time?
Well, good morning, Lisa. You know, China's inflation has been nothing much to talk about for a long time. We've been talking about sub 2% inflation, except in times when pork prices have been stalling. So we're at the low end of a distribution, but we're not nearly in a deflationary range. The signs of deflation are not there in China in particular. The monetary aggregates are still growing, although not as fast as they'd like them to grow, and wages are still going up. So I'm not particularly scared about deflation in China. What concerns me more is that of a deep recession in China that might have impacts on the stability of the regime, on the stability and constancy of economic policy, and that's where I think the big risks are. China, unlike the Western economies, doesn't respond to interest rate cuts, to the normal kinds of consumer spending or depressing policies that we see in the Western world, because most of their growth is driven by investment and not by consumer spending, and most of that investment is planned by the state. The problem with their growth engine is that they've run out of really lucrative investment projects, and that's causing their growth rate to slow down on a secular basis, and that's what they have to try to offset by switching the source of growth from investment to consumption, and that requires a careful mix of policies.
Just quickly, Carl, how likely do you think it is that there is some sort of deeper recession within China?
Well, I think that a recession is probably not the right word. It would be what we would call a growth recession, where growth doesn't occur fast enough to absorb people who still want to come from the farms into the city and to generate the increases in income that people want to see. I think that's the scenario we're looking at in China, subpar growth. So we'll see growth this year of maybe 1 or 2 or 3% is our forecast, about 3%. But that's way short of what they want, which is in the 5 to 6% range, and that's a problem for policymakers.
Carl, thank you for your insight. It's always valuable. Carl Weinberg there of High Frequency Economics on China and what's developing at the moment. We're describing this morning as an easing posture because it's hard to get your hands around actual policy measures. The excitement last week following the Politburo meeting, so this top body of officials in China, policymaking officials, Lisa, led by Xi Jinping, it was the absence of a line that the Chinese president uses on houses. They're for living, not for speculation. It wasn't included this time around. So there was a feeling from China watchers that maybe they were stepping back from that. They'd encourage some investment, maybe do some things to help people buy some more homes if they want to. These are the kind of little nuances at the moment. If you're waiting for cold, hard, blunt stimulus to supercharge this economy, I don't know if it's going to happen or not. That's a judgment about the future, but an observation about where we are currently. It's not happening yet.
I did a panel with BNP Paribas in China 15 years ago, I'll say, and I just had no understanding of how the entire discussion in China is about property. That is the avenue for the masses to try to husband savings and trying to make gain.
But this is the reason why they don't want to lean into that lever, because they have inflated this market so substantially. They're worried about a bubble, and they want to create a more even and developed market in their economy that emphasizes the middle class. They can't do that if they continue to inflate housing that isn't occupied in a significant way. I mean, the whole concept of ghost cities isn't sustainable.
A third of the country. I mean, Jonathan Anderson at UBS did legendary work on this. John, is a generalization. Don't quote me on the number. A third of the company is vacant. A third of the country is vacant. I mean, without exaggeration.
Yeah, I don't know where the numbers are right now, but TK, you're right to describe the problem. It's a real issue. The fact of the matter is, we're at the end of July. I keep going back to this. Just think about where we were 8 months ago.
Yeah.
Before the start of 2023, when we were talking about China being the place where the boom would come from for growth. And it's been that disappointing that we're having a discussion going through Q3, out looking into Q4, about the prospect of stimulus. out of China. That's where the disappointment has been in 2023. Your equity market on the S&P 500 slightly positive from New York. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Forward guidance when you don't have any idea where things are going. We do think you're going to continue to see improvement on the inflation story, but not significant enough improvement that's going to allow central banks to say mission accomplished. The big issue is on the growth side. As we look forward, we think that those excess savings are basically spent.
The rate cuts are here. They're just not coming from the Fed and the ECB. They're coming from Latin America. We'll talk about that in just a moment. That was Tony Rodriguez, the head of fixed income strategy over at Nuveen. To start a brand new trading week and close out a month of July 31st. Your equity market shaping up as follows on the S&P. Equities with a lift by 0.08%. It's a quiet start stateside, let's put it that way. In the bond market, yields a little bit higher by 3 basis points, 397.87. Payroll's the next big stop on Friday. The median estimate in our survey currently 200,000. Do you remember the days, Tom, when every month it was just 200K? We're back to estimates of 200K.
Let's stop there now and reframe this. It was 150 was sort of the run rate, and then it would be above it, and people would scratch their chins and say, why is it 200?
This was pre-pandemic.
225, pre-pandemic. And then there was some modeling about what potential GDP is, and that non-farm payrolls, heaven forbid, would be 125, and the bold would say 90, and that. I don't know where those numbers are now. But in this employed America, 200's a shock is a low number. What if it comes in at 250? I mean, what does the Fed do? I mean, I just don't know.
I hope that CPI doesn't start picking up again, Tom, with it. And then we're facing the prospect of them being in no man's land and hiking interest rates and losing faith in longer variable lags and getting caught wrong-footed big time. They want to slow this down. It's pretty clear, evident by the recent communication.
Is Damien here for emerging markets or the MLB trading deadline?
Well, let's start with EM.
Okay,
Rate
let's
cuts
start
out
with
of
EM.
Chile, 100 basis points.
more than expected.
With talk that maybe Brazil follows on Wednesday. These were the original front loaders. Got in first, and they're going to leave first too.
Yeah, no, and Hungary's already been cutting. They were one of the first ones. Now Poland CPI came in a little bit less than expected overnight. You know, now you're starting to see people expect them to cut as well. But, you know, the big story overnight, as we know, is China. And the fact that, you know, she is trying to pull whatever lever he can to fuel growth. And without addressing the demand side of the equation, I mean, all of these measures just really aren't having an impact, even though you see equities up 10% over the last week on very light volumes. Foreign funds are buying 5 days in a row, all the good news. But it's the summer, so you really...
Get away from this Damien Sassar minutia. To our listeners and viewers, should they be studying and should they consider being in EM and international equities and bonds, just as a general statement?
Well, right now, seeing as emerging market local debt is up something on the order of 11 to 12% year to date, probably waiting for better entry levels at this point. But look, there's still some juice left in the fact that a lot of countries have not announced their easing cycle yet. So that's typically a good time to go into these economies to start receiving in fixed income. But once they start to move, that's typically a bad time. That's typically where you don't want to be moving in. And we're starting to see that, as John rightly points out.
Within EM, which country should we be studying the closest? You mentioned China earlier, but is there a unique opportunity that we need to read in on and get smarter on?
I think it's the Asian high yielders. I think it's Indonesia and India right now because, look, they did hike rates, but there's really no sign that growth is coming off there. So they're really not going to be easing as quickly as some of these others in Latin America and Eastern Europe, I think. And look, let's be real. Let's be clear here. All of the export growth we're seeing, or whatever exports we're seeing out of China, are not going to the Europe and the U.S. anymore. They're going to Southeast Asia, right? So let's see how healthy the Philippines and Malaysia and some of these other countries are and how they're weathering the storm.
How much is this going to be a rate cutting and interest rate just general story in emerging markets, and how much is this going to shift to a commodity story? As you see oil prices post their biggest monthly gain going back more than a year, and you see this pretty much across the commodity complex.
It's such a good question. I mean, look, oil, it's anyone's guess as to where it's going next, but interest rate differentials are real. And if you look at performance year to date across the whole of not just emerging markets, but G10 currencies, it's all about carry and the reach for carry. And right now, if you look at a place like China, it's negative carry relative to the U.S., so it disincentivized not only foreigners from investing in China, it also disincentivized Chinese corporates who have a lot of dollars parked offshore from bringing it back onshore, and I think that's a big risk as well. Let me just add to that, the yen-funded carry trade has funded pretty much a lot of the price returns, the gains we're seeing on paper out of emerging markets. If that rug gets pulled out from under our feet, it's anyone's guess as to what we're sort of, kind of negative feedback loop we're going to see into some of those currencies.
There's a lot to unpack there, including what the Bank of Japan is actually doing, which is a big question mark. But just sort of doubling down on this interest rate story, you're saying when they start cutting, that's often a sign that it's over. It's counterintuitive because usually people say that in the developed world, when they start cutting, it's time to pile in, not necessarily on the currency side, but on the debt side. Why is it so different in the developing world?
Well, it's historical precedent, right? It's getting out in front of the news, and then when the news actually hits, it's typically time to sell. At least historically, that's been the case. This is a very new environment we're in. It's a different cycle, Lisa. So you're right. There may be quite a bit of juice left. We're talking about rates in Brazil that are 13.75%. So there's a lot of room to cut rates back down to levels we saw during, COVID. So yeah, you're right. There could be a lot of carry gains, a lot of that, but certainly look, we've got a lot of duration supply coming into the U.S. We've seen a lot of supply come in, but it's been bills. To see duration come in, let's see if that will cause the crowding out effect that all of these prognosticators have been waiting for. And look, I think you just don't want to sell short the fact that U.S. liquidity is so critical to the to the broader emerging market and G10 complex.
EM is fascinating right now. The prospect of easing out of China, rate cuts in Chile, maybe Brazil, Argentina easing in Miami, stimulus down there. Do you want to talk about that? The Messi effect.
He won't play.
Florida.
He won't play on grass. He won't play on turf. That's going to be a big deal for. Some of these matches that are.
So you've got to describe that for people outside the United States.
Right.
There are still grounds in this country in MLS that have artificial turf.
Correct. And it's bad for the knees, bad for the legs. Messi's career is on the line if he believes he's playing.
So he's not going to play on artificial turf.
So there are like Atlanta FC, right? They have the Falcons playing there. They have I don't know, but I was reading some article that basically said they can't get the MLS turf up and the grass down quick enough because MLS is like the bastard stepchild of sports. And so I guess at the end of the day, he's not going to play. I don't know if I can. Am I going to get in trouble?
Well, you did.
But
I apologize for it later.
Sorry. But you know what I'm saying. Ticket sales, are still up huge across the board. But now he may not actually be playing. Come on.
You follow this carefully. We make jokes about it, but Damien's a real student of this as well. What have you learned by what Mr. Cohen has spent on the Mets? We've seen this before, but I would suggest we've never seen the scale of I want to buy it now. What have you learned about the Mets' disappointment this year?
It's very hard to predict, and pitching is everything. And it's very hard to get...
Pitching is everything.
Pitching is everything. It's hard to get good starting pitcher. It's certainly hard to get... look at the Yankees. Their bullpen is in utter disarray. So I think, if you're looking at Major League Baseball and you're looking at Stevie Cohen, he's trying to do all the right things, but you can't buy your way into a championship. You have to develop your farm system. You have to kind of, stick...
Like
George Michael, go from the ground up.
He's finding out the hard way. over in the UK when it comes to the Premier League. Try to do that with Chelsea. It's difficult. It's difficult. Even if you've given a blank check and you can go out there and buy players, Tom, you can't make it happen overnight.
Tell us
Never
about
mind
the
baseball.
French football player.
Kylian Mbappe.
I loved him in the World Cup.
It's
It's
going
like
to be
why I
fascinating to
watched.
see. He is one of the top strikers alongside, I would say, Erling Haaland in world football at the moment. There's only a handful worth a significant amount of money, but PSG face the very real risk that they lose him for nothing next summer when the contract's up. Clearly, Damien, they don't want that to happen. There is a suspicion that he's already got a pre-contract agreement with, say, Real Madrid.
But it's not the El Halal $333 million. It's going to be maybe a little bit less than that.
Do you think that's going to change sports?
The Saudis.
In a
Or just
massive
the whole
way.
thing? I think it already is.
If you're a player right now and you can earn that kind of money,
How can you say no?
How can you say no?
I mean,
well,
how can you say
Mbappe
no?
reportedly did say no to that much money. Reportedly did say no to, but you get the feeling now this is just going to completely upend the cost structure of Premier League football clubs in a monster way.
And you think about what other sports out there are subject to that same sort of disruption from, I mean, I think of college sports here in the U.S. with NIL and everything that's going on. Who's to stop some deep-pocketed investor from offshore coming in, getting behind a university and buying up all these, you know, sophomores and juniors and redshirt freshmen?
Yeah, but
and
would they even get any money? Because they don't even get paid, right? They're not
well,
even allowed
now
to
they
take,
do. But
good equipment.
NIL, now they do. Now they do. So I think, you know, college sports is one. I mean, Major League Baseball is another. I mean, look,
So
for all
let's-
intents and
let's
purposes,
get
if
into
you want to
that.
pay the luxury tax, you can just buy players.
Out of all the sports right now, who do you think is most vulnerable to that? We've talked a lot about golf. We've talked about the Premier League.
Well, golf
What's
obviously
next?
is now. I mean, look, I think Major League Baseball is a little bit open to it. College sports is another one that really kind of hits me. Not the NFL; they have the cap. You know, certainly not basketball. They have sort of, you know, a cap there as well.
Tennis, you just buy the top 20.
That's an interesting one. I hadn't really thought of that. Yeah.
Why not?
Why not? Right.
Play 6 times a year.
Yeah.
Instead of being on the tour, which could be pretty grueling, you're going all over the place.
Are you their agent? What is this?
you-
You're making
I
a
could think
pitch.
of certain tennis players that
Are
are
you
going
doing
that
anything
direction.
tomorrow?
Am I doing no?
We should have Damien come in all through August. I mean, it's great entertainment.
You know, we have.
sports.
You know, can I talk about another property on Bloomberg
No,
Business
we're
and
going to break.
Sports?
You know,
No, we've run out of time.
Oh,
we're running out of time.
sorry.
But watch it.
I
Watch
promise
it,
you a little
watch
bit
it.
of time later. Watch it, whatever it is. Damien Sasser of Bloomberg Intelligence. Live from New York, your equity market slightly positive on the S&P 500. Coming up next, Barry Bannister of Stifel. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, you know, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, you know, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per
per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend.
We need to get inflation back to target first, and I think that is the risk.
The Fed is at this tenuous point. They need to make sure inflation doesn't reignite.
We're at the end of the rate hiking cycle in the West.
It really is once that economic data has deteriorated and you're in a cut cycle that you start to worry about those big downsides.
If the economy stays strong, there is the risk that the Fed might have to hike more and do more work to get the slowing that they need.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The Bank of Japan doing its best to disrupt what was otherwise a nice, quiet summer Monday. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500 just a little touch firmer, slightly positive on the S&P by 0.1%. Talked a lot already this morning about the earnings from big tech coming on Thursday, Apple, Amazon on Friday, the payrolls report. Tom, need to look back just a touch on what's happened with Japan. A tweak to yield curve control on Friday. We wanted to work out what the line of the sand would be. Is it 0.6%, 0.7, 0.8? Would they let it go all the way to 1% on a Japanese 10-year government bond yield? And Tom, they're already back in the market today.
Yeah, the Bank of Japan makes it day two. And again, all I can do is watch the litmus paper, which was 142.26 yen, a weaker yen here. We've had some good conversation on it this morning. I thought Carl Weinberg was quite good as well. But I would go back to earnings as economic data. Microsoft is, to look back a week. February, OMG, we're all going to die. Late April, OMG, we're all going to die. End of July, Microsoft, it's terrible. We're going to die. And they had a nice bounce the last part of the week. Are Apple and Amazon an economic proxy within the stock market for America?
The two names that are up something like 50% so far year to date, they have this in common, Tom. They've surprised to the upside so far in 2023. And this economy, in many ways, Lisa, has surprised to the upside.
So here is the tension point. Is this a soft landing? Is this a natural disinflation? Or is this that there are signs of weakness that haven't yet come through in some of the earnings? Or could you see a reacceleration in inflation? Those are the three outcomes that people are looking at, and no one can consolidate around one particular view.
Well, the consensus view right now, and I think we can call it consensus, just hopes and dreams of soft landing and soft landing data through the rest of this summer, Tom. That's the hope, the dream of the equity market bull currently.
I'm looking at the GDP numbers. I was on sabbatical here, and, I glanced at them, and I don't think I'm out at 3% GDP. But let's remind ourselves, 2.5% real GDP is a solid number. I wonder if we're going to have a solid August, a solid September. I put out on Twitter this weekend the success of Renaissance Capital and Neil Dutta in defining what solid is over the last 18 months.
The optimism, 2% real, is a million miles better than recession, which is where a lot of people thought we might be come the end of summer, Lisa.
I wonder how much people are sort of suggesting at this soft landing, but their conviction is in momentum. Because on the margins, people are quite concerned that you either get inflation reaccelerating or you get a more material slowdown. So from an investing standpoint, a lot of people are saying it doesn't matter. For right now, as Brian Levitt said, make hay while the sun still shines. Let's go. And it might not last, but right now it's too early to say exactly which direction it's going to go.
The city's a great example of that on the economic side of things. Andrew Hollenhorst thinking inflation reaccelerates. On equity trading, you've got the likes of Stuart Kaiser, who says we're in a sweet spot. You can see further upside, Tom, through the summer.
Year to date, it's just not Apple. Year to date, SPX up 19%, NASDAQ Composite up 37%, Dow trailing up 7% as well. These are good numbers. I mean,
across the board.
The broadening that's happening, and I didn't see that much rationalization this weekend. I guess everybody was off. But
well, give him a chance to write that.
Mike Wilson wrote, but
still 7:03.
Still young.
Wall
It's
Street
true.
time on,
fair,
on a
fair,
Monday morning.
fair. It is.
Where are your notes this morning? Equity futures on the S&P just about positive by 0.1%. There's a lift in this equity market. Yield with a little bit of a lift as well. Up, Lisa, by 2 basis points. Your 10-year 397.
Today, we are going to be focusing on the earnings to come, but also very much the Fed's Senior Loan Officer Opinion Survey at 2 p.m. We have seen a gradual tightening in standards. How much do we see that continue, especially given that the Fed was saying that this has shown a tightening in credit conditions? To what degree will it matter again to markets? This week's labor data includes JOLTS data on Tuesday, ADP on Wednesday. I love this. Nobody cares about ADP until it comes out, and then everybody loves it. Productivity on Thursday. Friday is the jobs report. Unemployment has flatlined. At what point do people start to say this is not sustainable in order to get inflation lower? Even Neil Kashkari, and you pointed to this, John, earlier, Neil Kashkari, in an interview with Face the Nation, said it seems unrealistic that we are going to get inflation lower without some sort of tick up in unemployment. And for earnings, yes, it's Amazon and Apple on Thursday, and yes, they basically are the index, but there are 169 companies generally of the S&P 500 reporting. So how much are these going to remain the main stories after delivering more than 50% gains so far this year?
Unreal, and close to 60% gains on Amazon. Just absolutely unreal. Joining us now to talk about this is Barry Bannister, Chief Equity Strategist at Stifel. If you haven't been lucky enough to follow Barry's advice through the year 2023, it sounded a little something like this: constructive for the year ahead, a price target of 4,400 on the S&P. And then Barry, more recently, and welcome to the show, by the way, you and I have talked about this already, you're looking for that flat line from here. So Barry, constructed through much of the year, and then just as a lot of people start to get on board and start calling for a sweet spot in the summer, you're calling it a flat line from here. Barry, just explain why.
Hey, Jonathan, good to see you again. Yeah, a classic recession was never in the cards in the first half. You know, when you helicopter drop 25% of fiscal and monetary into an economy, you're not going to have a recession. It's the largest policy experiment in 80 to 90 years since the New Deal and World War II. So that was a fairly easy call. I think going forward, the two things that we're watching most closely on the economic front are productivity and oil, because productivity is going to drive your unit labor costs and your core PCE inflation. And oil, you know, I think we're still wrapped up in geopolitics. I think oil is a big risk in the next 12 months, and I don't hear many people talking about it.
Barry, what I find interesting here, and I go to Mario Gabelli on this with Mario's work in autos a million years ago in media. You own capital goods. You own, as Gartman would say, things that fall on your foot and hurt you. Tell me about ball bearings. Tell me about Eaton. Tell me about Roper, the world of Bannister from years ago. I know it's underpriced. When does it pop?
When I look at various economic indicators, and we've always been big fans of like the PMI manufacturing from the Institute of Supply Management, I would take the over, not the under, on the next 3 points. And that's good for the industrials, which I covered, as you mentioned, for about 20, 25 years. The financials also fit into the value category, and basic materials. I would throw in energy, though. Energy and energy services, they're really dirt cheap on cash flow. They're indispensable for as far as the eye can see. And so when you look at that cyclical value in total, it should outperform cyclical growth, which is your big tech, because I do think the market's a few points overvalued. And it's because of the PE ratio, unrealistic expectations regarding financial conditions index that really don't justify the price-to-earnings ratio that we have right now.
If I've missed the Bannister bull market, how do I begin to invest now? Do you dollar cost average blended index, or do you go more specific sector?
Well, we did, as I just mentioned, the sectors, and there are sector ETFs for all of those, as well as sub-industry, level 2 industry ETFs at BlackRock. They do a great job with that. I would also say that you go long, equal-weighted, short, cap-weighted S&P in the second half. That's RSP long, SPY short. I like the diamonds over the Qs, so the Dow over the NASDAQ 100 in the second half, and I would buy some protective puts for late third, early fourth quarter, around September, October, because I think there'll be some turbulence as the unemployment rate ticks up towards the Fed's 4.1% year-end goal. We get perilously close to that trigger point, a sort of a modified SOM rule of a 33 basis point increase in the 3-month moving average of the U3 unemployment rate. And that would signal a recession could be on the horizon, and they're usually surprises.
What about the people who say, you know what, all of this macro call stuff just hasn't been working, and don't fight the consensus, as Peter Scheer said, don't fight consensus in December and August. Brian Levitt saying, make hay while the sun still shines. Why not just go with momentum, given that in August, not a lot's going to push against that, including even the data?
Well, if you do, you can use a forward PE, a trailing PE, and we're particularly fond of using a CAPE PE, a PE on trailing 10-year inflation-adjusted operating earnings in our calculations, and overlaying it against the Goldman Sachs Financial Conditions Index, which is an excellent, well-constructed FCI. If you do that, and you do it for the Powell era since 2017, you'll see that the market's about 2 turns or 2 multiples overvalued. So we have some downside here on that momentum trade that you reference. What we're doing is more tactical trading in the back half after participating in that macro trade, which worked out quite well in the first half.
Barry, wonderful call so far this year. It's great to catch up once again. Barry Bannister there of Stifel on this equity market. Looking out for some more difficulty in the back half of 2023. Certainly anything but for the likes of Barry Bannister, who called this market correctly, looking for a rally, and that's precisely what we get. But calling this market and this economy has been so difficult. Lisa was tweeting up a storm over the weekend about housing. I noticed that. I was reading the same thing over the weekend in my reading, Lisa, and I came up with this stat from Redfin. More than 9 of every 10 US home owners with mortgages, so that's 46.1 million, more than 9 out of 10 have a mortgage rate below 6%.
Yeah.
And the proportion of people with something like 3 to 4 is pretty spectacular as well, which is why so many people aren't moving, why Lisa inventory is constrained.
And this is the reason why prices can remain high, even though interest rates supposedly are high, but so few people are paying them. So you extrapolate this out into the corporate world, and Lori Calvasino of RBC this morning put out a series of decks showing that companies are also mostly paying very low rates tied to the low rate kind of world. So how interest rate sensitive is this economy that we're looking at right now?
Well, the debt reissue is going to be interesting. It's going to be interesting with Apple as well to see, and they won't do it in the same day. They usually spread it over 2 announcements. But do they reaffirm share buyback by doing another mega bond deal, which is what they do? And again, that's within a higher interest rate environment. John Stolfus just reports, and he has a classic Peter Lynch insight here, John. This is Stolfus at OPCO. Know what you own. Boy, know what you own in October of last year was easy. Everybody, doom and gloom, up we go. That was easy money. Right here, right now, you know what you own.
Doom and gloom was the easy money.
Listen to Bramwoods. Yeah, the first leg of a bull market is easy. No, but if you believe in the maximum doom and gloom, if you believe, look, here's the rumor. If you believe in maximum Bramo,
right,
that's when you go long.
So Bramo's job
that's
is
easy monny.
Okay.
Now it's a second leg in Stolfus 101.
I'm really excited for the next commercial break. This is going to be great. If you're just joining the program,
we'll do big little on that.
Welcome to the program. The S&P 500 positive hills by 0.1%. Coming up in about 45 minutes, we'll catch up with Michael Purvis of Tallback and Capital Advisors on this equity market. And we have talked a little bit about the lack of pass-through to savers from those interest rates, never mind the borrowers who aren't paying it just yet. In the UK, the regulator getting very frustrated with British banks not passing this on to savers, and they may well be gearing up to force them to. I'm not sure how they will, but the latest on that a little bit later in the program.
My chart of the weekend, not that I was on sabbatical, so I really wasn't looking, but money market fund assets. The public is voting, and they're voting for higher yield. They're moving, it's convex up. No ifs or buts about it.
They're going to force them to pass the savings.
There is talk. There are not so subtle threats.
Okay. I'm sorry, what is this? So first tell people, okay, no wage increase for you, but we'll make the banks pay you money. Honestly, are they trying to...
This is the regulator.
Okay,
but do they have money market funds in England? Do they have money market funds in England?
They have fixed-term deposits. They have things like that. I'm sure there are money market funds.
I don't know.
Sure.
I don't know. Here it's huge. The yields, and they're beginning to model 6%.
There aren't 5 trillion 5 trillion.
$5.5 trillion.
Something like that.
Yeah,
right?
it's huge, ginormous.
And one idea that's being thrown around is how stimulative is it that people are getting money off their money again? How stimulative actually does it end up being at a time when they're not really paying the higher interest rates?
Sonia Miskin coming up soon of BNY Mellon Investment Management. Looking forward to that conversation. That conversation about 15 minutes away. Your equity market positive by 0.1% on the S&P from New York. This is Bloomberg.
Connection lost.
Three prime ministers, 4 chancellors, an energy crisis and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. PJT Partners CEO, founder, and chairman Paul Taubman sits down with Bloomberg's Shonali Basak for an exclusive deep dive into the state of business. Tune in live at 10:45 a.m. Eastern, only on Bloomberg, your global business authority.
The economy continues to surprise how resilient it is. We don't want to declare victory. We're making good progress, and we're staying on it. If we need to raise rates further from here, we will do so, but we're going to let the data guide us and not prejudge the outcome. Right now, we know shocks can hit us, but right now the base case scenario seems to be that we'll have a slowing economy, but that we would avoid a recession, and I hope that that's true.
Hope is not a strategy. Ultimately, Neil Kashkari, the Federal Reserve Bank of Minneapolis president, speaking on CBS, by the way, over the weekend, believes that hope is somewhat unrealistic. That line, though, that we've heard a million times, if we need to hike, we will do so. But we're going to let the data guide us and not prejudge the outcome. It's basically copy and paste from the Fed to the ECB, and Lisa, pretty much to every Fed speaker we're going to hear this week, I imagine.
Which leaves us in a question of which data matters and what happens if the data doesn't show what they need to know before it's time for them to make a move. It doesn't really leave us with any more clarity.
No, but they want to provide less clarity to maximize what they're calling optionality, right? Isn't that the approach?
But a lot of people are saying that data isn't going to show the slowdown or the reacceleration in inflation, whichever side of the debate you're on, until it's too late for the Fed to really respond to it. So by de facto, are they just basically saying, we're not going to make a call and we're going to be late one way or another?
It showed a slowdown. They hiked interest rates anyway. So Tom, figure that one out for us, please.
I just think it's a mess, and it's going to be the economic data coming out. And what people want to focus on in the doldrums of the summer is this is an exceptionally busy week. And there's just all there is to it. We're a lot smarter at 9 a.m. on Friday than we are right now.
8:31, hopefully. when payrolls comes out on Friday morning. Your equity market on the S&P, firmer by 0.1% on the S&P 500. Yields just a little bit higher by a couple of basis points, 396.88. What was that stat on the oil market? Biggest monthly gain potentially, Lisa, since early last year.
Yeah, exactly, in more than a year. And we're looking at potentially adding to those gains as people talk about the tightest oil market going back years, even though we haven't seen that pop.
TK crude, 81. 29.
Yeah, I'm glad you mentioned that. Brent crude as well, the world price getting rounded up $86 a barrel. I think that's a quiet story, John. Here for July, oil's just sort of crept up.
Under the radar, right?
Not breaking up, but it's under the radar as well. Right now, we're going to go under the radar with Emery Horton, our Bloomberg summer presidential correspondent. And whether it's FDR up to Hyde Park or various presidents in Martha's Vineyard with A-listers, there's something about a president going away. For President Biden, I hope I'm pronouncing this correctly, Anne-Marie. It's Rehoboth Beach in Delaware. He has a Delaware State Fair to look at. He has his bicycling on the boardwalk to look at. Describe where he is and the mood at the summer White House.
Well, let's hope he's also safe on his bicycle, because we have seen him fall off that bicycle when he is in Rehoboth. That's where he'll remain for the week. And then next week, he's really kicking up in terms of looking forward to 2024 as a campaign candidate. But as president, he'll be going to some states like Arizona and like Utah. So this is just a bit of a summer lull. But that's just in regards to his public schedule. I don't think it's a summer lull in terms of what is going on behind the scenes with his family. We do have a very close associate, a very good friend of his son, Hunter Biden, Devin Archer. He'll be behind closed doors today with the House Oversight Committee. We shouldn't say Congress is shut, but there is this hearing that is happening, and a lot of eyes, especially from the Republican Party, will be looking at this in terms of what this individual potentially can say about Hunter Biden's business dealings, whether it was with China or Ukraine, and potentially what the Republicans want to show is that there is some sort of smoking gun that would link this to the current president, Joe Biden.
Emery, we try to do economics, finance, investment, and all of that. A balanced approach here is the mandate from our founder, Matt Winkler. Along with for our international audience, the cable news cycle in America is polarized by the travails of the president's son. How focused is the president on this day to day? Is your reporting, your perception, all the context you have, is this a president riveted by the travails of his son, or is it something being handled from a distance?
Well, I think like any human being, something happening to your child, right, is going to weigh on you. But obviously, I think the president probably tries to, and this is me just projecting, I don't really know how he feels about this issue. I know he does not like to speak about his family, especially Hunter Biden, in this way in public. We did over the weekend get a statement, the first time ever the president has acknowledged his 7th grandchild, which is Hunter's child living in Arkansas. But the president doesn't really like to talk about Hunter publicly. He probably likes to put things in boxes, right? Family and presidency. But I imagine as a parent, this weighs on the president and the first lady as well.
Anne-Marie, there's a larger issue here, especially given the former President Trump's legal issues. And some people saying even if he could win the Republican nomination, he's not going to win the general election. Likewise, there's a question around Joe Biden and the enthusiasm that he can bring. And if he is paired up with Donald Trump, is he definitely going to win, or are there signs pushing against that, given the fact that there are some real issues, there are concerns about his age, and a lot of unresolved questions around how his tenure would go?
So 2 things. First, I think, and many Americans think both these individuals are just too old. And you're seeing that really start to come out now, given what we saw last week, whether it was Senator Mitch McConnell, whether it was Senator Dianne Feinstein. There is a growing call, and Nikki Haley talked about it yet again over the weekend at the Iowa dinner. There's a growing call of a new generation of leaders. But yes, those concerns certainly weigh on Biden at the moment because he is the acting president of the United States. It's not a for sure conclusion that if it was going to be a rematch of 2020, Biden versus Trump, that Biden would win. I don't think anyone could today project who is going to win the November 2024 race. The polls show that Biden would have this lead on Trump, but I think it's just too far out. Remember, at this time in 2015, yes, Trump is an incumbent now, but at this time in 2015, the top 2 candidates in the GOP horse race was Jeb Bush and the former governor of Wisconsin, Scott Walker. Trump was at 1%. Chris Christie, another current challenger of his now, was at 6%. So it's just too early on. We haven't even had our first presidential debate to speculate. But obviously what you see within the Republican Party at the moment is this massive lead Trump has. And I think the latest New York Times Siena poll, their first of this race, really shows that. And there's one line that stood out to me in that poll about when individuals are asked about Trump and DeSantis, who are the top two candidates, but Trump clearly is just crushing DeSantis in this poll. And they say people like Mr. DeSantis, but people love Mr. Trump.
You talked about Nikki Haley proposing a competency test for everyone who is an elected official over the weekend, and you heard Asa Hutchinson's response, which is, that sounds nice, but it wouldn't pass muster constitutionally. And Maria, have people looked at doing something like a competency test and found that legally it would not fly?
I think there's been lots of talk about this, especially given this polls well with Americans. Most Americans want to see upper age limits, but the fact is they also say that if there's a candidate that is very wise, even if they're older, but can do the job and is fit to do the job, they should be able to. It'll be a hard one to get through Congress, but at the moment it is being used as a very big talking point given the backdrop of what has happened in Washington and the fact that you are seeing scary moments and worrying moments of elected officials struggling right in front of the public, right in front of the camera. So that is why this has been a major discussion. Whether or not it leads to legislation, that remains to be seen.
Hey, mates, let's squeeze this in. Last week, there was a victory lap for Labour off the back of a deal between UPS and Teamsters. Yesterday, Yellow, we're talking about one of the oldest and biggest US trucking businesses going out of business. Have we had a response from the White House yet on that?
Have not seen a response yet in the White House, Jonathan, but obviously the press secretary will be briefing today, and I imagine that will be one of the top questions to her alongside everything else that's going on with the Biden administration and his family.
30,000 jobs, I believe, TK.
Yeah, it's
there,
huge.
Potentially, it's a big deal. Anne-Marie, thank you. Down in Washington, 22,000 of those Teamsters members, Lisa.
And Teamsters had been negotiating with them and couldn't come to a resolution. They said that they wouldn't even come to the table, which was a key question at a time when Yellow said that they offered them raises that they didn't even negotiate on. So really some questions here.
Like you, I'm always looking for some kind of macro signal. The more I read about the company, the more I believe that it's just a Yellow problem, Tom.
You are correct.
All the
right?
debt.
I have to be careful.
Maybe not a signal about the broader economy. Right now. Equity futures on the S&P 500 slightly positive by 0.1%. Sonia Meskin of BNY Mellon Investment Management coming up next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Third week of gains on the S&P 500 last week, looking to add to them this week with earnings on Thursday from Apple and Amazon, and then payrolls to set the tone at the back end of the week. Futures right now positive by 0.1%. On the NASDAQ up by 0.08%. Talked a lot about the weightings on the NASDAQ. The monster big tech names, Amazon, Apple, almost 17% of the NASDAQ 100, which is just
That's
nuts.
amazing. I did not know that.
Isn't that incredible?
Two stocks.
It's ridiculous. Let's turn to the bond market. 2-year, 10-year, 30-year shaping up as follows. Muted gains in a 2-year yield last week by close to 4 basis points. On a 2-year this morning, unchanged at 487.66. Data dependent. A lack of clarity, including from Neil Kashkari over the weekend in an interview with CBS, who basically said, we might hike. We might not.
Is he a hawk or a dove this week?
He's whatever he wants to be, Tom.
Yeah,
we might
exactly.
hike, we might not. It's totally data dependent. Let's see what the data brings through the rest of summer going into the September Federal Reserve meeting. For the ECB, wow, what a difficulty for them in the FX market. The euro this morning, slightly stronger, 110.32, after the biggest weekly decline, I think, on a single currency against the dollar going back to May. The data, so GDP, here's the good news. Lisa, a bit of growth. Here's the bad news. It comes with inflation, core CPI above headline CPI for the first time, I believe, since 2021.
This is a big concern at a time when energy kind of saved Europe in a lot of ways. People thought that that helped fuel some of the GDP gains. And now we're looking at potentially a slowdown in China, and we're looking at energy prices going up at a time when core inflation driven by wages and all of the other kind of services-driven sectors are accelerating. How do you put that together?
Oh, with difficulty. Let's put it that way. Under surveillance this morning, plenty of difficulty to follow the BOJ. The Bank of Japan surprising markets again, announcing an unscheduled bond purchase operation to try and do something about the drift higher in yields we've seen over the previous 24 hours. Yields spiking to 9-year highs. The bank announced it was buying the equivalent of more than $2 billion of bonds. Tom, it comes only days after the bank tweaked yield curve control. Right. So did it move too quick or did it breach a certain level?
And your great introduction there, John, it was all yield analysis. They refused to talk about price because they don't want to talk about price. And the answer is yield up, price down. Somebody within the complex system, as Carl Weinberg brilliantly mentioned an hour ago, has to take a loss within these closed systems, this domestic system of the Bank of Japan, the Ministry of Finance. Somebody somewhere has to take a loss. That's the great unspoken right now.
The buy side itching to short some of that stuff. The spillover still unclear. You'd have to imagine, Lisa, you get to a point at some point somewhere where yields start to shift so high, the domestic investors start to bring the money home. So everyone's looking for those vulnerabilities in places like maybe France, across Europe, and including, for that matter, treasury markets to some extent.
And that's a reason why I personally was kind of surprised there wasn't a bigger reaction to an adjustment of the Bank Japan's yield curve control. But it's exactly because of them stepping in at 0.6% to buy bonds that people are not reacting more. We just don't know the extent of what they're doing and how far they're willing to let things kind of normalize.
You and I were talking about growth out of Europe. Allow me to bring you the numbers. So a return to growth, second quarter GDP advancing 0.3%. This after shrinking and stagnating in the previous 2 quarters. It's just not great right now for the ECB because that growth profile, Bramo, comes with core CPI of 5.5%. You'd imagine they've got more work to do. They don't want to commit to it. We've talked about the lack of clarity from the Federal Reserve. Take a listen to this from the ECB. This quote is from Lagarde, but it could be from Powell or Kashgari or anyone. A pause, whenever it occurs, in September or later, would not necessarily be definitive.
Right, basically trying to make it a hawkish pause, right, because we might have to go again. The issue is, and you said this earlier, John, and I think it's an important point, that now we're not hearing the dissent as strongly. Later in the year, it gets a lot tougher when you have to start to interpret the data and give some sort of forward guidance, especially if this trend of subpar growth and sticky inflation persists.
Next to war, we're going to revisit eurosclerosis. And what's interesting about this is, where's their Amazon? Where's their Apple? They don't exist.
Hermes.
We have LVMH.
Yeah, LVMH.
I think that we are seeing the lack of innovation, the dearth of innovation, and this within wonderful French productivity. We're seeing a dearth of innovation. There's no Google, there's no Apple, there's no, blah. We all know the story.
Yeah.
The Economist or Bloomberg writes it up beautifully, but to me, that's the heart of the matter.
That's what's held back the equity market for so long, Tom.
Not only the equity market, but just the spirit of the place, the nominal GDP, the pop of the place.
I went to Italy and it felt like they were doing okay.
You were in Italy?
Yeah,
I didn't know
it felt
that.
like they were doing okay.
If 3 islands off the shores of Italy is big in Italy.
It felt like they were doing okay. Let me turn to this story. I mentioned it a little bit earlier. The UK's Financial Conduct Authority is warning of what they call robust action for banks that don't transfer benefits of higher rates to consumers. 9 of Britain's biggest lenders, this includes HSBC, Barclays, NatWest, have only passed through about a quarter of interest rate rises to savers. This is from the FCA. So they've been looking back at the rate hikes, all 150 basis points from January out to May. The pass-through has been something like 51% to so-called fixed-term deposits. Instant access savings, so this is where the bulk of savings are. You go in, plant your money, take it back whenever you want. The pass-through has been 28%. That's where the problem is.
Has it even been that, though, in the U.S.? I don't think it has been even close to that, because if you have your money in a deposit account, you're probably getting zero still in the United States.
I'm getting very little.
I know, exactly. I mean, this is a personal gripe of mine.
Wait, but can't British people go to a money? I mean,
there are money market funds.
When Harry Kane resigns with the Tots, he can go to a money market
They're
fund,
aware
right?
how sticky these bank savings are, TK. So there's very little incentive to pass it through. But ultimately, the regulator wants to do something about it. I'm waiting to see how much teeth these threats actually have this morning, and we'll see, Tom.
Is there a Tottenham watchdog?
Would you like a Tottenham
I'd like
watchdog?
a Tots watchdog this morning.
Maybe another time.
Here, we'll do that in a moment. Right now, joining us is someone with one of the toughest jobs in the history of the IMF. Sonia Meskin had to work for Tobias Adrian there, which is pretty heavy lifting. Out of Pennsylvania, LSE, she joins us with BNY Mellon this morning on U.S. Macro. You had to do the Green Book with Tobias and everyone else at the International Monetary Fund on financial stability. What's the financial stability, the arc of financial stability in America look like right now?
Well, it probably looks better than after 2008, but that doesn't actually say very much, does it? I think that it's helpful that the balance sheets of both households and corporates have been much improved since COVID. What we're seeing, the effect that we're seeing now from that improvement is really in the consumer. And we've been able to withstand a lot of curveballs in the American economy in the last couple of years. These people have been predicting a recession for a couple of years now, right? At least a year. And we haven't seen it yet. And we've just now turned the sentiment towards the expectation for a soft landing. But I would say that even though the labor market is still quite strong and the balance sheets are quite strong, there's still risks out there.
Okay, the risks out there, like commercial, like the Gloom Crew, what Bramo talks about all the time, the commercial real estate. Or there's a lot of questions about the loan business, the leveraged loan business as well. Do you at BNY Mellon, with the longest dividend since time began, John, it's like 1630. They've been doing a dividend since the Pilgrims hit the rock. And the answer is, the answer is, there are these worries out there. Can they intrude into the prosperity of America?
I think that the bigger the exposure of various actors within the economy, the higher the risk. So if you look at CRE, for example, there are different subsets of CRE. And of course, office space in major metropolises is not coming back, at least in the foreseeable future, to where it was pre-COVID. But there are other elements of CRE, for example, like multifamily mixed-use spaces that are doing better.
Meanwhile, a lot of people are questioning why we're seeing disinflation. There's the crew that sees a soft landing, and that this is just the natural year-over-year comps coming down and back to the normal pre-pandemic. And then you have Bloomberg Economics' Anna Wong, who says the disinflation seen in recent data is not the death of the Phillips curve or an anomalous break between net demand and prices. It's because there are real cracks in the economy. Long after supply chains have normalized, it's a downdraft in demand that's driving the current wave of disinflation. Do you agree?
I think it's still, the jury is still very much out on that, because we are seeing still quite a strong labor market, and we got to ask ourselves, why is that the case? And the correlation between core services inflation and wages is historically over time has been relatively strong. I do think we're seeing a deceleration. Is it real cracks that are going to put us into a recession next year, or is it just a stabilization from very high levels of activity in the recovery post-COVID? It's still difficult to say. What we're seeing in the market, though, is that people are really reacting to pieces of data that confirm the soft landing and are ignoring parts of the data that may be pointing to a more significant deceleration, or even to potentially, very sticky inflation down the road.
And the reason why is because of the employment market, as you were saying, that has remained so strong, and we get a number of indicators this week, as we've been talking about throughout the morning. From your vantage point, how soon will we see the softening in the labor market to know quickly enough for the Fed to adjust? In other words, in their data dependency, when will they get the data that actually is true to make those decisions early enough?
It's very hard because it's a lagging indicator. And we are seeing a very big difference now between, again, still, even though it's come down, between job openings and actually people looking for jobs. As long as that continues to narrow without people actually losing jobs across industries, I think we're safe enough, but that could change on a dime, and it's very difficult to look at the data that's somewhat backward-looking, such as the non-farm payrolls, and see signs of when that may be coming.
We've all read lots of research recently about student loan repayments later this year. Torsten Slock of Apollo put out some numbers for us just moments ago. Allow me to share them with you. There are a total of 45 million people with student loans. The average monthly student loan payment is around $200. He says resuming student loan payments in October will subtract roughly $9 billion from consumer spending every month, or roughly $100 billion a year. Does that move the dial for household spending for you? Is that number big enough?
On its own, I would be loath to say that it will, but against the background of generally slowing economy, it may. And I think that actually a higher rate environment, it's hurting consumers already. But as long as the job market stays strong, it has less of an impact than it may on corporates, who will need to refinance into a higher rate environment in a year or two.
Away from the aggregate number as well, Lisa, you go through some of that research. It's about which households, younger versus older, all over again.
So this really raises a question of the Instagram crew who travel to certain places in order to get that Instagram photo, and might not do that as much anymore. I mean, how will this impact, Delta's earnings? Or
what's the average age of a cruise at the moment?
I don't know.
That's not the younger demo, is it?
No. You think maybe
that's
Disney
the older
cruises?
demo.
Why are you asking me?
No,
Since when was I a cruise expert?
I'm intrigued. You went on a cruise, didn't you?
No, I did not go on a cruise.
I thought you went on a cruise.
No.
He said you went on a cruise to Norway.
I did not go on a cruise. No,
oh, okay.
I was
Should
in
never believe
Alaska,
it.
and I was definitely not in a cruise.
Not in Norway, in Alaska, not a cruise.
Not a cruise.
You're in Alaska?
Yeah, I did see
Where did you
fjords,
get
though.
Norway from?
I thought her people told me that. One of her interns
You said it was a cruise. So
my
wrong
God.
place, wrong mode
Do you know
of
she
travel.
only has liberal arts interns? Do you ever notice that?
Okay.
No.
Yeah.
Do you take me for a cruiser? I'm sorry, no offense, but I'm just wondering.
Tell us more. That's great. That's great. Leave the camera on, Bramo. That's perfect.
It's okay. I'm
Keep
just
digging.
really surprised.
I'm so
Let's move
offended.
on.
I'm so offended. Sonia, thank you. This was great. Thank you. I won't ask if you cruise, please. Sonia Meskin of BNY Mellon Investment Management. If you're just tuning in, welcome to the program. On the equity market, on the S&P, we're positive here by 0.12%. Coming up at 8:30 Eastern Time, Mark Zandi, Chief Economist over at Moody's Analytics. Looking forward to catching up with him ahead of payrolls later this week. And looking forward to this, Zach Brown, the CEO of McLaren Racing, TK, joining us next on this program.
Really well timed. This is a really interesting gentleman. He is somebody, he's a driver. He's somebody who's in the game, who actually has done it. And he's got these two young kids at McLaren who you know better than me, Lando and Oscar's all I know.
Piastri
and he's got to manage them on a daily basis. This is not Alonso's 42 this week, or, Perez and the Belgian guy, at Red Bull. This is somebody running 2 kids right now.
So I consider myself the demographic that they all want to speak to, who knows nothing about F1 and is American, because that seems to be
Netflix.
Yeah, exactly.
Yeah.
That dabbled in Netflix to understand what you guys are talking about.
You like the bright orange?
Exactly. Okay, but moving on. But really, I'm curious, as an American who has raced in this sport, bringing it to this country, what is the difference in how F1 will have to change to adapt to an American audience?
John had a tweet out on this fixation they have of going to the back end of the race to micro stuff. You put out a tweet,
drives me nuts.
You're dead on. They don't, I live in mortal fear that they go from British broadcasting to American, because the British guys are doing great.
Max Verstappen's very outspoken on the difference between what people watch on Netflix and what actually happens on race day.
You mean I don't understand fully?
No, I'm not saying that at all. No, I'm just saying that I think
don't.
Max believes that they stir up a lot of drama that doesn't exist maybe on the programme.
Yeah.
It's all content, isn't it? Equities right now, positive by 0.1%. Formula One and McLaren Racing up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Formula One is gaining so much momentum. It's gaining viewerships. The Netflix series Drive to Survive have brought in a whole new generation, also much more multi-gender to the franchise. And for us, it's an absolute key pillar in our sponsorship strategy.
That was the Heineken CEO catching up with Bloomberg a little bit earlier on today. It's been amazing to see the attention that Formula One has attracted over the last couple of years, TK. I was very happy when you started to take an interest in Premier League football. I'm perhaps a little bit more happy you finally got around to follow this, because I always thought this would be the sport for you because it captures all of your interests in one thing.
The late, great Ken Pruitt used to throw pencils at me because I had no interest in F1. And I have to admit, as with the Heineken gentleman, the Netflix series is the one that got me going. And there's, the British guy married to one of the Spice Girls, and there's Tito Totto, the Mercedes guy.
I'm sorry, what?
And then there's this American
You're talking
guy.
about Christian Horner.
Yeah, and then there's this American guy who's he's like in fury. I didn't even know what McLaren was. And the answer is, you get to know these people. It's the only sport where, you're looking at the managers and the executives in the same way you look at the drivers. It's very cool.
A great lead into our next guest, Tom.
It is. Am I doing well here?
This is wonderful.
Okay. Right now, and this is a joy after what we saw in Belgium, to bring in Zach Brown. He's the Chief Executive Officer of McLaren Racing. And to give you an idea of the breadth, the scope, the scale of his history with racing, he actually was in the cars doing it. at a very young age. And he's someone that also has a great amount of Americana, including a precious letter from George Washington to someone arguing about the travesty of Benedict Arnold. This is a Renaissance man, John, running things at the August. You told me McLaren was special.
It's very special, and it's a special opportunity to catch up with Zach Brown of McLaren Racing. Zach, wonderful to catch up with you, sir. A difficult weekend compared to the success in Hungary and at Silverstone in the UK as well. Zach, can you catch these Red Bulls this year? Can you get a win?
Well, we're trying. We're trying. We need them to blink. But, you know, there's a lot of racing left to go. We're getting closer. Unfortunately, no one's close enough yet. But I would think a win is possible in the second half of the season. It's certainly our goal.
What is it about the setup of the car, the developments that you've made over the last several races, Zach, where you think you've made progress? And what kind of races on the calendar do you think we can see that a little bit more?
Aerodynamics, you know, it's very much an aerodynamics game. Of course, you have to have two great drivers, which we have, and you have to have great pit stops and reliability, but it is an aero game, and that is where we've made our biggest gains. We started that in Austria. I think some of the quicker tracks, so I would think Austin, Japan, we should be strong. Abu Dhabi, we should be strong. It's the slow corners we don't like, but who likes going slow anyway? So, but that's where we need to improve. And we've got some more developments coming, but so does everyone in Formula One. So it is definitely a development race.
Zach, I watched every minute of Belgium, and somewhere in the vicinity of lap 31 or 33, there was Zach Brown talking to a 22-year-old kid quietly who had gone out of the race early as well. Oscar Piastri is 22. At 14, he was basically a professional. That's all these kids do is drive, drive, drive. What were you saying to Oscar Piastri at lap 33 there after he bombed out of the Belgium race?
Yeah, I told him a couple things. One, don't worry about it. You know, he had such a great Saturday. He's having a great season. So these guys feel like they not only let themselves down, but the team down. And so they need to know we're all in this together. We win together, we lose together. And then also we had a pretty difficult race with our aero setup. So at that particular moment, Lando was going backwards until we kind of strategically got him in a better place. So I also told him he probably wasn't missing having too much fun at the moment, just being a little bit lighthearted. And, you know, these things happen. He's done a fantastic job all year.
Explain to our American audience, including a dummy like me, what did Bruce McLaren give you? What does the McLaren name mean to John Farrow in auto racing?
I mean, he was a legend. He was all about innovation. He was a driver. He was a designer. So, you know, we're very proud to wear the papaya colors, which was Bruce's colors back in the day, and that was actually done so he could have more standout on television back in the black and white days. And so he's an inspiration to all of us, and he was a racer, he was an innovator, he was the designer, and of course a team owner. So we're the second most successful team in the history of Formula One, and something that we're very, very proud of. And we were also the only team to have won what's called the Triple Crown, which is the 24 Hours of Le Mans, and the Indy 500, and of course the Monaco Grand Prix, and it's something that we can hope to do again in the future.
Zach, as you try to plow further into the U.S., this is something that Formula One has tried to do, is I'm learning, and I'm one of the people who are becoming the adopters here. Where is the distinction, the overlap between Formula One and NASCAR? How competitive is that at a time when NASCAR already has such a cult following in the U.S., and Formula One has a very different type of energy coming from Europe?
Yeah, I think they're complementary. They're different. You know, they're probably have almost the same similarities between baseball and basketball because they're radically different as far as the type of racing. So a little bit of a different demographic and psychographic. Obviously, Formula One is very global, where NASCAR's a domestic sport. But I think all motorsports help each other. So I think there's room for both, including IndyCar, which is much more like Formula One. It's just awesome to see how big Formula One has got in America as quickly as it has. And I think Netflix obviously has a lot to do with that, as does the Austin Grand Prix. Miami Grand Prix and the soon-to-come Vegas Grand Prix, which is going to be off the charts.
As a lot of purists probably feel that the Netflix series perhaps inaccurately reflects some of the drama or the lack thereof, as Max Verstappen, as John was pointing out, has noted, as an American who has been in a sport that really has been dominated by European presence, how does the sport have to change to really become as popular in the U.S.?
Well, I think it is changing, and a lot of credit to Liberty, who acquired the sport, 5-6 years ago. I think Netflix is a great example. That would have probably not happened with previous ownership, because the industry, the sport, would not have wanted the cameras on the inside of the sport. It was kind of wasn't an inclusive sport, and I think now we're very digitally savvy. We've embraced the fan. We're all about the fan, and things like Netflix, where we're showing people about our great sport. And I've seen some of those comments, which are a little disappointing, because I think they're a bit inaccurate in the sense of we're capturing our great sport. When Netflix puts together the content, they'll sometimes pick and pull because they're trying to illustrate a point. So we, as the racers, will see, for instance, oh, that was a clip of our pit crew from Monaco, but they're showing us in Italy. But it kind of doesn't change the narrative. So I think we're a little bit too close to it. And because Formula One's all about the details, we get a little bit wound up when the detail's a little bit inaccurate.
Zach, tell me how the commercial agreements have developed over the last couple of years. Let's just say, for example, we wanted to put Bloomberg surveillance on the side of Lando's car. Let's just say.
Let's just say.
What's the cost of that now compared to what it was several years ago, Zach? How much has the price of that increased?
It's probably gone up twofold in 5 years. And I think what's great, though, is the exposure is gone up fourfold. It's all about value for money, but the demand, I mean, if we look at our partners, right? Google, Cisco, Dell, Goldman Sachs. I mean, these companies were not considering Formula One 5 years ago, and now you've got the world's greatest companies joining those that were already there. So it's been an unbelievably commercial success.
Zach, real quickly, and by the way, John and I think we can piece together $5,000 to get Bloomberg surveillance on the side of the car. You guys are always tweaking the cars. Now, you've got a summer break like Pharaoh has a summer break. I mean, John's taken off all of August into September. You go from Belgium to Netherlands. Is your car going to be tweaked and different for Netherlands, or do you actually take a real European holiday?
No, well, a bit of both, but everything's about advanced planning. So we will have new bits, if you'd like, on our car in Holland, but those have already been developed. The shutdown is for the technical team, is mandatory. We can't even send an email. So I'm going to go to America and spend time with our IndyCar team, because you can't keep me away from a racetrack. But no, it is a very genuine, you cannot touch the race car for 2 weeks. You can't even communicate about the race car, but that's all planned in. So our developments are already ready for Holland.
I'm having that written into my contract.
I was going to say, is everybody?
Zach, I love it.
Brad, Qantas, did you just hear that?
Zach Brown of McLaren Racing. Zach, thank you, sir. Appreciate it, and good luck for the rest of the season. Some recent success from McLaren. Heading in the right direction, Tom. It looks better and better.
And these two young kids are rock stars.
Very cool. Michael Hervis on the market, up next.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their
their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I think this goes higher for longer, and I'm talking about equity markets right now.
The data continues to come in pretty good.
There's been tremendous momentum in the consumer.
As we look forward, we think that those excess savings are basically spent.
We're still actually a long way from price stability.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Staggering into August is what we do, and we stagger tomorrow to the ISM data. John Farrow taught me it matters. Within all of we got earnings, economics, and all that, John, we start tomorrow with that first indicator, ISM.
You make us all sound drunk, Tom, going into the data tomorrow, staggering towards
I'm off my sabbatical. Leave me alone.
Amazon and Apple on Thursday. TK, it's a big week to kick off the month of August, just around the corner.
It's a big week to do the data, and as I've said earlier, I think the earnings story here and the great gloom misguess that we got on earnings and all that is part of the economic data. Apple and Amazon equate to ISM.
Typically, we would say the market's not the economy, and would pick out the tech names that have raced to these double-digit gains year to date and say they're tech, they're not representative of the economy. But the economy's been doing much better than expected, and there are several stories outside of big tech which speak to the resilience of discretionary spending in America. We joked about cruise lines a little bit earlier this morning. The airlines as well have been a big story for 2023.
Yeah, maybe it's two Americas. Lisa, what I would go to, we mentioned this earlier, is very quietly the story of July, underreported as West Texas Intermediate, 81 the barrel, rounded up, Brent crude, $86 a barrel, is up a nice percentage.
And a lot of people are wondering why it didn't happen sooner, given that everybody is going around, whether it's cruise ships or whether it's airplanes. Demand is better. The actual consumption of gas, of oil, has actually gone to some new records. So this isn't necessarily either an economy or a world moving away from fossil fuels or people who are slowing down, which raises a question of why it isn't even higher at a time when people say the supply-demand balance is completely out of whack, Tom.
I was deep into my sabbatical. The provost called and said I have to publish off it. You know what my paper's on?
What's
it's
that?
A working paper. It's in peer review right now.
Okay.
The Tao of Tank. It's going to be very good. Anyways, off my sabbatical, what intruded was the Bank of Japan. And I'm sorry, the Bank of Japan intrudes again. I got a 142.22 on yen. I guess the yen's done nothing, but the Bank of Japan has acted.
So the Bank of Japan, in their own words, haven't dropped yield curve control. They're just going to tolerate some breach of the 0.5 ceiling that they've had for a while and pledge to come in at 1% every single day if they need to, but then they came in at 0.6%. So I think we're still asking the same questions from Friday. Is there a line in the sand? Do they care about pace or levels? Have they shifted policy, tweaked it, whatever word you want to pick on Friday, to make the easing more sustainable? Or is this a genuine step towards tightening? And the fact that we're all sitting here trying to figure it out speaks to the ambiguity that you and I have been talking about, Lisa, for the last couple of days. It is by design. And at the moment, it's not having any negative consequences for now. Lisa, if it starts to induce volatility and the market starts to test them because they're not providing that clarity, then we've got a very, very different story.
And if you take it a step further, is the strategic ambiguity that the Bank of Japan is executing only possible because we're also getting strategic ambiguity from the ECB and from the Federal Reserve?
Where does strategic ambiguity come from? It was Friday, right?
It was Jeff Yu. But he actually...
somebody mentioned this, like the Bank of Japan or somebody?
No, that was Jeff Yu, I believe.
Was it Jeff Yu?
And Mike Gapin of Bank of America to describe the Federal Reserve.
You brought that up.
Sure.
But the idea
it's the phrase
here
everyone's
is,
throwing around, Tom, at the moment.
The idea here is they are not looking to provide non-guidance.
Right.
They don't want guidance.
Right.
They want the markets to go on their own accord according to the data and not driven by any expectation of their policy.
My strategic ambiguity is the Red Sox couldn't get it done not once but twice against the San Francisco Giants this weekend. John, let's start the data check here. I'm going to go to the all-time high measure. How far are these equity indices away from the all-time high? SPX up 5%, Dow up 3%, NASDAQ 100 adjusted rebalanced up 5% as well. We're getting there.
Wow. And some people still calling it a bear market after gains of
Some
close to
people
30%.
Not Michael Purvis. We'll get there in a
from
moment.
the October lows. Equity futures right now positive by 0.1% on the S&P 500. There's that lift in crude at 1%. Lisa on top of that story, $81.40 on WTI. Yield just about unchanged, 395.88. If you are just tuning in, the data out of Europe, GDP, at least there's some growth. That's where the line is in Europe right now. That's the bar. But CPI is still a problem. Core inflation in the Eurozone, 5.5%, Tom. With an ECB still umming and ahhing about what they're going to do in September.
We launch into August right now with the most important interview of the day. He's at Tallback and Capital Advisors, and with decades of experience, he writes a piercing, direct note. Michael Purvis joins us, the CEO of Tallback. And Mike, for congratulations on being in the market, saying I've got to participate in the market. What's the now what on a second leg? You bounce off 74, 73 recession, big pop in 75. Nobody in January of 76 was ready for the second leg. How do you frame the second leg of this bull market right now?
Well, I think it's really going to come down to rotation. I mean, the big tech has clearly done a lot of impressive lifting here. They've blazed the path forward. They've had the most aggressive PE expansion. I think too much PE expansion. You look at NVIDIA's earnings, which have been, bottoms up street consensus estimates have doubled over the last quarter, kind of steal some thunder from what's going to be coming, I think, later this summer. So I'm not sure, the AI excitement, I think we're going to go into much more of a Missouri show me type of mentality on a lot of the AI narrative. The rest of the market, however, value and cyclicals, it's been a tough thing to own because we're supposed to get this recession, right, at some point there. That said, the valuation, it's night and day. And the spread on valuations between a lot of the cyclical and value indices and the big tech is at record wides
Where do you acquire this morning on a sector basis? Energy,
look,
banks,
I think one of your guests earlier this morning stole some of my thunder. Energy and industrials, I think, look really very, very compelling. I think there's structural stories there with regard to some of the big sort of second wave of capital expenditures that's happening in the United States. Part of the ESG story is really much tied to the industrialization. Relocalization is tied to industrialization, and then on the energy companies, you look at, you were talking about crude rallying. It's up 12% off the recent lows without the benefit of a weakening dollar or a surging China, right? And I think that's sort of speaking to the fact that maybe we don't get to that 120 oil that was thrown around, or 150 oil was thrown around a year ago, but if there's a higher floor and a more stable floor, which I think there is, given the sort of the new era of supply considerations from the big energy companies, you're going to see, those are cheap stocks there.
Right now, we're talking about the details of tweaking around the edges, and yet a number of guests have come on and said, look, the data is really confusing. Right now, don't fight momentum. What's the point? It's August. Or almost August. Do you kind of adhere to that as well?
I tell you, in the number of years I've been doing this, I've never been more sort of intellectually tormented by the fact. You look at some of these charts, and it could be sugar futures, it could be whatever, right? It's a chart. The charts look incredible, right? Incredibly bullish. Like, you don't want to get short that chart. Then you step back and you think of, okay, wait a second. We're looking in 2024. I've been very constructive, or I'm very sort of non-bearish, I should say, on the economy coming into this year, right? But still, you're going to see, and I'm very of the view that we're going into a different, higher nominal GDP world for a lot of reasons there. Without all that said, nominal GDP will come in 2024 from what we've been using. And as that happens, you're going to see some earnings deflate. I don't think it's going to be negative. I just think we're going to go into like a 4 or 5% index earnings growth. And is that enough to justify 20 times on the S&P 500?
So does that mean that you are joining the FOMO, or that you're not? Are you pushing back against it?
I invented FOMO.
Well, I am with this, right? I am not recommending to my clients bearish trades right now, except on a couple of individual specific stocks,
like who?
Right? Well, I think, frankly, NVIDIA is looking is cracking. But would I go short the Qs just yet? Probably not. I'm not bullish on the VIX either. I actually think there's a lot of reasons to think that the VIX is going to stay in the sort of sub 14 range for some time.
You codified a study of ADX, the Asian index ex-Japan, the JP Morgan index. How do you interpret the Bank of Japan dynamics of the last number of days? How does that redound over to the rest of the Pacific Rim?
Well, let me bring that back to the U.S. Treasury market first, because I think it is really, really important. If you look at where, it was just a year and a half ago, it was all, $17 trillion of negative yielding debt, right? A lot from Europe and of course from Japan. The bunds are in a much very different place today, and JGBs look slowly after so many years starting to wake up and get out of that. And I think that will reinforce rate volatility into the U.S. And I think that will reinforce a higher floor in U.S. Treasury yields. I think that it's inevitable. I don't think it's a fast, sudden process. You talked about, remember back in August of 2015, the Chinese shock devaluation, Tom, that was really what got that VIX correlation with the ADXY so tight. I don't think that is happening this time around. I think it's a slower moving but very structural force that also sort of speaks into this sort of higher nominal world we're going to.
I can't believe that was 8 years ago, which is kind of nuts thinking about where did that go? Where did that go? Are there vulnerable bond markets at the moment where there is a bigger presence of the Japanese-based investor that you think perhaps may face a little bit of pain as Japanese investors start to bring money home?
Well, look, I think, again, I'm looking at life more through the sort of a U.S.-centric lens here. I'm not Damien Sassower, worrying about, Malaysia.
Lucky for you.
International flow dynamics.
But from a flow point of view, I do think it's going to be, again, nothing sharp and sudden. I do think it will mean that, here we are sort of edging up in 4% on the 10-year. A lot of people wouldn't think we were going to be there. I think we're going to stay there longer. I think this is one of those contributing factors. If you look at the SOFR futures over the, forget what's happening the next 12 months. That's kind of tired news in a way. Look at years 3, 4, and 5 on the SOFR curve. Those are lifting higher into a new place, and I think that's a little bit of a tell that we're going into sort of a higher floor for treasuries. And I do think that for all this talk about headline is crashing in the U.S. Yeah, it has been coming in quite quickly, right? But if you look at the last 3 spikes above 6% CPI over the last 50 years, we never got to 2% after those spikes there. So I think that's something we got to be watching really closely.
Michael, good to see you. As always, Michael Purvis there of Tallback and Capital Advisors. If you are just tuning in, welcome to the program. A lift on the S&P 500 going into big earnings and some big data later this week with payrolls on Friday. Equity futures firmer by 0.16%. At 8:30 Eastern Time, so 18 minutes from now, we'll catch up with Mark Zandi of Moody's Analytics. Looking forward to that conversation before payrolls on Friday. The estimates at the moment, the median's 200K. If you break it down on the Bloomberg terminal in our survey at the moment, so let's take the top two ranked economists over the last couple of years. So number one, Stephen Gallagher, SocGen, he's looking for 190. Number two, Stephen Stanley, now of Santander, 270. Tom, so they're your top two economists on the street when it comes to forecasting payrolls, looking for something in and around 2, maybe a little bit higher?
All I know is I'm not going to look at ADP. I still don't see the correlation between ADP.
Everyone said that until the last ADP report.
On Friday, but...
And then boom.
I look, we've just been so wrong on this. I'm going to take a 3-month moving average, and it's a fully employed America. When it goes, I do agree, when it goes, it will go quickly. But it hasn't gone.
Well, claims aren't breaking out, are they? They're breaking down.
Yeah,
At least they're going the other way.
Well, and this is the reason why JOLTS might be interesting tomorrow, the job openings data that we got. But Sonia Muskin on earlier said that this can move really quickly, right? And so this is my question. When will we actually start to see this lagging indicator show weakness that everyone's waiting for? I mean, you pointed to Neil Kashkari. This is what he said on Face the Nation. I personally don't think that's realistic, that we're going to get some sort of decline in inflation without some sort of pain in the labor market. There's going to be a cost to the labor market.
You know what's interesting? A little bit later, we get the senior loan officer opinion survey, and no one is talking about it. And 3 months ago, that's all anybody was talking about. And tumbleweed this Monday morning. From New York City, good morning.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Every BOJ meeting is probably going to be live up ahead. I think everything is on the table. We know the trajectory is towards tightening and comprehensive conditions, the phrase that they're using, and markets, yen, equity markets, and in particular, JGB's global fixed income will need to react accordingly.
Every trading day is live for the BOJ at the moment, it seems. Jeff Hughes, Senior Market Strategist at BNY Mellon. Those comments coming after the Bank of Japan tweet what they call yield curve control. Basically, they have a target rate, they have a ceiling, and then they told us the ceiling wasn't really a ceiling, it wasn't rigid. They would tolerate some kind of breach of it, come in at 1% every single day if they need to, and then didn't get anywhere near 1%, and they came into the market today. So make sense of that. Everyone else is trying to. On the screen today, what you do get off the back of it is a weaker Japanese yen, dollar yen 142, that currency pair firmer by 0.75%. The broader story in the market at the moment is a lift to equities to kick off the trading week this Monday morning. Good morning to you all. Equity futures up by 0.15% on the S&P 500. Yields just about unchanged to up a single basis point, Tom, on a 10-year 396.28. And that stealth rally in crude that hasn't got a ton of attention, really, relative to the monthly move we've seen so far. 81.47. We're higher, Tom, by another 1.1%.
Yeah, I haven't done the work. Let's do the work right now. You can do this, folks, in the Bloomberg terminal with the TE function, Tom Edward. You take Brent crude, and we're riding the rail, John, up 2 standard deviations. I didn't realize how low we got. In June, we were down to $73 a barrel, and we're enjoying $86 a barrel right now. It's a moonshot up. That extrapolation, you pop through 90 somewhere. You know, we're on the plane to Jackson Hole, and we're at $90 a barrel.
The
That's
high gasoline price
extrapolation.
again. That all over again. Yeah, maybe.
We'll have to see. That's where we are. Right now, we are going to have the correct question for you to be briefed into August on the Pacific Rim, and very much so what's going on in Japan. Win Thin is Global Head of Currency Strategy, Brown Brothers Harriman, with all of us work at the International Monetary Fund, and just the thoughts here on the ramifications 12 time zones away. Dr. Thin, I look at this, and let me start with China. What does it mean for China if eventually in Japan I have yield up, price down?
Well, I think it's something not only China has to think about, but really anywhere around the world. The world has accustomed to basically sopping up Japanese funds that have gone elsewhere to chase yield, right? Zero negative yields in Japan. You go chase it in emerging markets, in the U.S. Treasuries, China. But, you know, we're in that pivot point where all of a sudden Japanese rates are going to start going up. Now, they're probably not going to rise as quickly as many would hope. We'll talk about the Bank of Japan operation later, I'm sure. But they are taking it very cautiously, so we're not going to have a huge jump in yields and a huge sort of turnaround in capital flows. But at the margin, I do think that we'll see more Japanese funds come home and be more domestically focused as yields rise. But again, this is a multi-year process.
It's a multi-year process. We have to think of the immediacy of $86 Brent crude again on the Pacific Rim. I was away Friday. We had Jay Pulaski on, who I think has just been brilliant on this. As a general statement, are you thumb up on the Pacific Rim? I mean, I know there's oil demand, but the interlinking parts of the Pacific Rim, do you see it constructively with optimism into 2024?
Well, Tom, let's bring it full circle back to the China question, because overnight we had some very weak official Chinese PMI readings for July. And that continues a multi-month trend. But, you know, we had this burst of optimism in December when China reopened, but since then it's been nothing but disappointment. We've had some pronouncements of some stimulus here and there, but really nothing really concrete. It's all very vague about the amounts and how it's going to be funded, et cetera, et cetera. So they're saying all the right things, but when all said and done, the economy continues to slow in China. That has ripple effects for a lot of the sort of Chinese-dependent economies: Korea, Singapore, Taiwan, obviously, Japan, even Germany. So look, the Asian Pacific region has in general very good fundamentals. We're talking about emerging Asia, but it's always been really, well, I won't say always, really the last 2 decades been dependent on this giant export machine out of China. And as China turns inward, doesn't sort of go back into this global export machine that it once was, it really has global ramifications. I think we're looking at very, very slow growth, really in emerging Asia and Japan as well. And higher oil prices don't help. I think most of the region imports oil. That's bad for the inflation numbers. So there's a lot of moving parts. I think I'm a little more constructive on LATAM in terms of emerging markets, but I'm much more cautious on Asia at this point, mostly because of China.
How difficult is it to have some sort of conviction and a trade, Chinese currency, but right now, even more so, the Japanese yen, given the confusing rhetoric out of the Bank of Japan and the fact that they're going to put their thumb on the scale in some way that we don't even know at every single daily trading session?
Yeah. No, Lisa, you really have just sort of hit the nail on the head there. So for the last 3 or 4 weeks, we've heard leaks and comments from the Bank of Japan that they weren't going to do anything at this meeting. And then all of a sudden, lo and behold, Thursday afternoon, North America, we get this leak story from Japanese newswire that, hey, they're going to discuss a tweak in yield control. So it really caught, I think, a lot of people off guard. We had a big move in the markets during the afternoon, but when all said and done, it was really sort of a very puzzling move. They kept yield curve control and they kept the target, but they made it a sort of moving target in terms of the upper limit. And I think it was a very half-hearted attempt to sort of do something. I think they squandered a lot of credibility for really a lot of nothing. The equity market is up and the yen is down. That tells me the markets really don't believe Bank of Japan. If I can just say quickly I haven't talked about this in months, but It's something my old professor at Columbia, Professor Mundell, the brilliant Professor Mundell, had something called the impossible trinity. Basically, what boils down to is you can't have free capital flows and also control interest rates and the exchange rate. You can't do all three. The Bank of Japan is trying to do all three. Where it's going to leak is the currency rate. I think that's where the pressure is going to be let out. So I think I'm more convinced than ever that we should buy dollar yen. We are headed to 145, if not higher.
Interesting, which also sort of might fuel some of your bets on Latin American currencies as well, because as Damian Sassower was saying earlier, a lot of those bets have been carry trades financed by the yen. How fragile are some of these Latin American trades based on what happens from Japan? In other words, how much has the weaker yen fueled a mass influx of capital into Latin America?
Yeah, very much so, at least I think it really into any sort of high-yielding currencies. So it's interesting you bring that up because last week we had a couple of surprises in emerging markets. Chile delivered a dovish surprise on Friday. They cut 100 basis points. And to me, that's where the tipping point right now is for emerging market currencies. We have developing market rates going up, 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 up. And all of a sudden, you have the emerging markets trying to cut rates at the same time. And it's you know, as we always know, the emerging markets has to have some sort of risk premium built in. And a lot of these policymakers in emerging markets are going to test that thesis. I expect if Chile continues to cut rates aggressively, that the Chilean peso will come under a lot of pressure. You know, the best performing emerging currencies this past year has been the high yielders, for obvious reasons, because the carry trade and strong fundamentals. But as that cushion falls, I do think it's going to be very worrisome. So I expect policymakers to really weigh this sort of the trade-off between, okay, let's boost growth, but at the expense of weaker currency. That's going to feed into inflation loop, et cetera, et cetera. So again, a lot of moving parts for policymakers all over the world. I would just say that I'm very disappointed that the Bank of Japan is an outlier in terms of just not communicating well with markets. You know, every other central bank, the Fed, the ECB, everyone around the world is trying to sort of keep markets calm, have them know what's coming or what they think is coming. And for the Bank of Japan to throw a spanner in the works on Friday was really, really, to me, quite shocking. And I'm not really quite sure it was worth it, honestly.
Well, Wynne, just to finish on that, is that just inexperience leading a central bank? We've seen moments like that from Chairman Powell and President Lagarde when they first had their first terms.
That's correct. But he did have a sort of a model to go off of. Remember, Mr. Kuroda gave us a little surprise in December before he left. So to me, he's sort of repeating the pattern. It really didn't do a whole lot. Again, yes, you could. I can be generous, Jonathan. I actually appreciate you saying that.
Don't accuse me of that.
It is growing pains.
Generous.
It is growing pains.
But central bankers.
Around the world, yeah, you're seeing lessons where you must be clear and concise.
I'll do better next time, Wynne. Thank you, sir.
No, nothing wrong with that.
Brown Brothers Harriman. Appreciate it. TK.
That was brilliant. Buried in there was the thin Columbia take on his advisor, Robert Mundell, who was a good friend of this show. This idea of the impossible trinity that Japan or any other nation faces when they make long-term bets, strategic bets, as Japan has made. It's just simple, and you can use the phrase from the TV show years ago, this math does not compute. It just doesn't work.
I'm going to step away, Tom, and head to the studio. Other studio.
Are you?
35 minutes. Jim Bianco,
they have a better
Bianco
breakfast there
Research.
than we do.
Sonal Desai of Franklin Templeton, Stuart Kaiser of Citi. On the data this week, the central bank, lack of communication, and the earnings on Thursday. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg Surveillance, Lisa Bramwitz and Tom Kane. Mr. Farrell on assignment. He goes to his show early because they have a better breakfast there. By the time it's 6 a.m., we're doing Pop-Tarts and all that. By the time they get to the 9 a.m. breakfast here at Bloomberg, it's like pretty fancy.
Yeah, we get Lucky Charms and he gets organic
Eggs Benedict and all that. Anyways, Farrell's off getting ready for the next hour, which is a good and beautiful thing. We welcome all of you here. Mark Zandi coming up in a moment. Very important conversation on glass half full, half empty on the American economy. But right now, we'll whisper into the microphone because the king of whisper data, Michael McKee, is here on a very busy week. What's the whisper number that matters this week? Is it jobs or is it something else?
Well, we don't do whisper numbers on a lot of different things, but jobs is going to be probably the most important thing of the week. I'm just looking up the whisper number right now. No, that's ISM. We do that for tomorrow. The whisper number is 47, so people think we're going to have a weak number, but the number for jobs is 194 at the moment.
A little bit lighter than the survey.
Lighter, but we're going to get a lot of data this week that will influence what all those late arriving forecasts will be.
Where will we be at 9 a.m. on Friday, given the compendium of data starting with JOLTS, which you've told me really matters, tomorrow, ADP and all that? What would you guess is we're going to feel Friday at 9 o'clock?
We'll feel glad the week is over because it's a very, very busy week for economic data. But the underlying feeling has to be that we will see a little bit of a slowdown in terms of job creation, but not much movement overall in the jobs numbers. The unemployment rate is not expected to change, and we're basically thinking that things have slowed down, but they're not falling off a cliff. But we'll get some interest with the senior loan officer survey this afternoon, although Jay Powell... So
that's a big deal?
It's one of those numbers that becomes a big deal when it just fits into the narrative, and that's
Lisa was making a big deal. I'm like, is this a big deal? I don't know. It's a big deal?
I mean, for years, I couldn't get you guys to put me on to talk about SLUs, but now you want to talk SLUs? Jay Powell said it's about as you'd expect, and he also said earlier that he thought the bank issues were behind us. So I don't think we're going to see a whole lot in there other than some tightening maybe, because that's what banks do when rates go way up. Then you got ISM tomorrow, ADP, and jobless claims on Thursday. All that will feed into what we get for the July jobs report in terms of forecasts.
August 1, tomorrow, I'm dusting off the cowboy boots for Jackson Hole. Has Jackson Hole changed in the last couple of weeks? Is there a different anticipation for it?
I don't think it's changed in the last couple of weeks, but it certainly changed from last year. We know what the Fed is going to do, which is we don't know what the Fed is going to do. They've made it clear that they're ambiguous at this point, that they could go higher, they could go lower, and it will depend on the data. And Powell gave us a list of all the numbers they're going to be watching, a couple of CPIs, a couple of jobs reports, a couple of PCEs before we get to the next Fed meeting. And so any one meeting like this, any 1 week like this isn't going to make a big difference in terms of what the market thinks the Fed is going to do. They'll be watching other things. I can tell you, though, that for those who are going to risk it and not be here this week, Bloomberg TV is channel 105 out in the Hamptons. So, you know, you can continue to watch surveillance, and we'll give you all the numbers, and then you can go to the beach.
That's Sonali Bassick TV out there. It's good. You know, Michael McKee, thank you so much. Greatly appreciated. This is a joy. Mark Zandi is a name you may not know. He's chief economist at Moody's Analytics, but he codified optimism in the depths of the 2008 recession, the great financial crisis. He's written a couple books on it, but far more, Mark Zandi said, and I'm going to say early 08, early 09, you know what? We're going to come out of this. We're going to be resilient. We're going to move forward. Dr. Zandi joins us now, chief economist, Moody's Analytics. Do you have the optimism you had then now, Mark? Can you look out 1 year, 3 years, 5 years, and see an America of productivity and real GDP gain?
Yeah, Tom, I can. I think, what's that Warren Buffett adage, don't bet against the American economy. I think that's pretty accurate. I mean, it goes up, it goes down, it goes all around, but cutting through all the ups and downs, the economy is resilient, and I do think our prospects are good long run.
Almost to the point of Romer of New York University, our Nobel laureate on technology and growth. The technology miracle we have in America right now, witness these stocks and all the AI and all that. How do you overlay technology now as an optimistic force for America?
Well, that's key to driving those productivity gains. You know, technology, innovation, entrepreneurism. You know, that's what makes the American economy exceptional, makes it tick. You know, if you look at the data, though, productivity growth has been pretty pedestrian, pretty tepid. I mean, 1.5% per annum over the past 3, 5, 6 years, and that's, you know, down from the 2% kind of per annum growth we got between World War II and the financial crisis. So we need more innovation. We need more entrepreneurism. We need more business formation. I'd say bring it on. We need some of that AI magic to kind of wash over the economy to get that productivity number up. Because, as you know, Tom, the demographics are difficult, right? You know, I'm a boomer. I'm going to age out of the workforce. A lot of folks like me are going to age out. Immigration is not going to save the day. So if we're going to get stronger growth numbers, we need to see those productivity gains, and we need to see that innovation.
Lisa, Zandy's not going to age out. He's cut and chiseled. I mean, he's like, you know, he's in Philadelphia doing the Eakins, crew down the river thing. You know, like the paintings from the night. He does like 40 miles a day.
Age. Mark, I'm curious.
Like me, Tom. That really sounds like me.
A lot of people are talking about how it's going to be really difficult to track some of this data and follow it because it's backward looking. So what are you looking for that forward looking indicator? Is it the Senior Loan Officer Opinion Survey that we get out at 2? Is it some of the ISM surveys that we get later in the week?
Well, Lisa, I think my favorite near-term indicator, where we're going to be over the next 6, 9 months is actually consumer confidence. The Conference Board measure in particular, I find useful. At the end of the day, particularly in the context of this debate, recession, no recession, because at the end of the day, a recession is a loss of faith. Consumers lose faith that they're going to hold on to their job, and they pack it in, stop spending, and of course, businesses lose faith that they can sell whatever it is that they produce, and they start laying off. We get into this kind of self-reinforcing cycle. And historically, when confidence starts to move south in a big way, in a consistent way, not too soon thereafter, we go into recession. But as you know, we got some data points last week from the Conference Board and the University of Michigan survey, and they all look pretty good. I mean, in fact, confidence improved. So, hard to say what the world looks like a year from now, but I think I can state with a high level of confidence through the end of this year, we're going to remain recession-free.
If that's the case, then what does that say about the ability for the Central Bank of the United States, the Federal Reserve, to really affect some sort of change in the economic condition? In other words, are we looking at a U.S. economy that's pretty insensitive to interest rate increases and maybe actually have a much higher terminal rate because it can keep chugging along regardless of the fastest rate hiking cycle going back some 40 years?
Yeah, I'm not worried about that. I mean, the key here is inflation, and inflation's coming in a pretty graceful way. I mean, and all the trend lines look pretty good. I mean, I forecast lots of things. Some of those things I feel very confident in, some not so much. This I feel very confident in. I think inflation is going to come in. We know vehicle prices are going to decline. We know the growth in the cost of housing services is going to slow. We know electricity prices are going to come in. So I think inflation is coming in here pretty nicely, to the degree that the Fed Reserve doesn't have to do anything. They've done all they need to do. We're at the terminal rate. We're good, money good. So I just leave things alone and let the economy, do its thing, and I think we'll be fine.
Dr. Zandi, if we make the assumption that this is a Fed that is more data dependent than ever, if they are what's called ex post, as we have never seen, what is the price, the damage, what is the risk we have if it's a Fed that has to act after the fact?
Well, I mean, what choice do they have? They have to focus on the data that they have and the data stream that's coming in. They've got a forecast, but it's obviously very dependent on the data that they have. So I'm not sure what the alternative is, from their perspective. They've got to look at a lot of different things, and they do, and I think they have to weigh them. But at the end of the day, they're tied to the data like everyone else. I will point out, though, life's very difficult for them, at points like this, because the data is based on surveys. The response rates to those surveys have been declining. The quality of the results that we're getting has fallen, and it's hard to tease out the so-called signal from the noise, and so it makes it a lot more difficult for them to get it right. But again, at the end of the day, they're slaves to the data. They've got to be beholden to what that data says.
Are you saying with inflation coming down gracefully that it's going back to where it was pre-pandemic, and that most of the increase in inflation was just pandemic-related distortions?
Yeah, exactly. Or Russian war. I mean, I think those two things, those two supply shocks, pretty massive, and they kind of conflated because they came on at roughly the same time, conflated and caused inflation expectations to jump, and then that's when inflation really metastasized. Got into the wage structure, and you got into wages driving prices, prices driving wages, the whole wage price dynamic. So, but at the end of the day, it's those two supply shocks that are at the root of the high inflation. And as those supply shocks fade from view, and they're still there, right? I mean, the vehicle prices I mentioned earlier, that's supply chain related. Japan and Germany can't produce because of supply chain issues. But as they fade away, then inflation should come back down reasonably gracefully. There's some room for the Fed to slow the economy down. I mean, it has been growing too quickly. It doesn't want to see unemployment go any lower, but the heavy lifting here is on inflation is really about getting to the other side of the pandemic and the Russian war.
Mark, I got 30 seconds. What's your 12 months forward real GDP number?
Tom, I think it's going to be around 1.5%, just below trend. Potentials too. So that'll allow the unemployment rate to tick a little bit higher, but well above zero. So I think we'll remain recession-free.
Mark Zandi, thank you so much. He's with Moody's Analytics. Lisa, you mentioned Moody's, and the spread that I use is an unsophisticated. It's the old Moody's BAA industrial spread as well. I was away so long on my sabbatical. Give me an update on spreads. Have we given way here?
No, they're going down.
They're still wicked tight.
The idea is the extra premium that people request to own riskier securities over benchmark treasuries. It's gone down. And this just follows the rally that we've seen in equity markets.
It follows the data that I see on my screen here.
And it follows the fact that even as defaults pick up, they're not expected to go up that much because you are seeing companies that have already refinanced, so they're not paying the higher rates and are in pretty good shape.
You will have to see. Right now, what we see is Standard & Poor's 500 up 0.2%.
I think it's really interesting, Tom, what Mark Zandi was saying about the forward-looking indicators being the surveys that call 100 people or 1,000 people and get some sort of indication of where they're at.
Yep.
How much can we get an actual read of accuracy from these? Is this really the best data that we have, or are we just totally in the dark?
That's textbook Mark Zandi, and he's 100% correct, and I'm hugely suspect about them. Have you ever been called?
No.
Has anybody ever go, well, so what do you think of real GDP? I've never had anybody ever call me.
Or ask about how I feel. Although a lot of surveys, at least more politically inclined ones, say that people feel the inflation story more than they feel the strong economy story. So it's a split kind of sentiment feel that we're looking at right now. In the meantime, you're seeing the housing market remain really strong. I've been watching that in particular at a time when this was supposed to be the first one to fall, and it hasn't. It's actually bottomed.
I think so many have been so wrong in the last 7 months. You know, John was brilliant about this 2 years ago, and that he was trying to get out to March 31 to make his annual review. This year, I think we're getting out to June 30th, or dare I say September 30th, to get a view on 2023. I mean, it's just flat out not there. There's no other way to put it.
Have you gotten out of triple leveraged all cash?
No, I'm not. You know, it's really, you know, I am going to watch Apple and Amazon this week. I've got an odd lot order. I think it's for Amazon. I can't, my brokers, my financial advisors. And so like, well, you know, 10 shares or should we go 12 shares? And, you know, no, I haven't made the first purchase.
No,
I just
can't do it.
Well, look at the yield I'm getting. I mean, you're talking 15% gross after 2 and 20 payout, net clean. I mean, it's pretty good.
Yeah, well, there you go. That's your pitch.
It's 10.35%. Money in the bank. Good morning.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Bloomberg Surveillance, we say good morning. Lisa Bramwitz and Tom King. John Farrow on assignment right now, getting ready for the 9 o'clock hour. There's a lift to the market. I'm going to call, there's a little bit of a bid here, Lisa. I mean, I know it's somnolent Monday. We're waiting for data, waiting for economics, waiting for earnings, particularly on Thursday. But to me, there's a little bit of oomph to the market.
Yeah, well, people are trying to get back in love with things that were beaten up pretty significantly during the pandemic. And I want to give you just a couple examples of that. Wayfair, which had a high share price of $345.47 back in 2021. Yes, it is $78.55, but it's up 7.5% because it was upgraded by Piper Sandler, saying that they're basically on the cusp of driving sustained EBITDA profitability.
Have you done Wayfair ever?
No, I haven't.
I've looked. I just don't get it.
Well, it's a furniture shipping company, which I guess now as people are finding that their homes are worth something again. Sweetgreen also, those shares up more than 7% as they're getting upgraded to by Piper Sandler. Anyway, it's just sort of interesting to see, and you're still seeing gains ahead of the Thursday earnings with Amazon and Apple.
We'll have to see here, and of course, Apple and Amazon front and center here with a little 190. I didn't realize Apple was there. I was on sabbatical, and you know, up and away. This is a joy. Her name is Allison Schrager. She worked with Glenn Hubbard at Columbia, where she took her PhD. But far more than that, over the years, she's been one of the most acute students of American behavioral economists. She has a little book, which is a glorious book, An economist walks into a brothel, I'm blushing, and other unexpected places to understand risk. And what you need to know in the book cover is, and on radio you can't see this, but she goes to the heart of the matter with a bell curve. It's tough to see there, but it's there, trust me. A bell curve, which is like the high school class height of your curve, and that's the artificial world that we live in, and there's a lot more going on with that. Allison Schrager joins us this morning. You start with Peter Bernstein. I was honored that he wrote an afterword for my book. Peter Bernstein wrote the book of risk, uncertainty, against the gods. You lead with the wonderful work of Peter Bernstein. How do you extend beyond against the gods with an economist walks into a brothel?
Well, I mean, you can't really extend beyond it. I think that was a beautiful book because it just shows how risk management really changed our relationship with risk. It became something that didn't just happen to us. It was something we could measure and try to manage and control. And I don't know if I could extend what he did, but my goal with this book was really to popularize it further. Because, I mean, it's a beautiful book, but it's an intense read, and was to sort of do for what Freakonomics maybe did for Applied Micro, to do something similar for financial economics, which I think a lot of people don't realize, even in economics, is the study of risk and risk management.
I mean, Steve Levitt with Freakonomics changed the world. You take it by anecdote to anecdote. Give us the one anecdote. Probably stay away from the brothel where I'm going to blush here on radio. But give us an anecdote within your book that explains how naive we are about risk and uncertainty.
Well, I think my favorite story, I mean, I also realized I needed to actually go and report these things myself because I didn't have the research career that Steve Levitt did. So my favorite was probably going to a risk management conference for big wave surfers, where I saw, you know, we sat in a windowless conference room, but they're all in board shorts and tank tops. And we had one of the most sophisticated conversations I've ever had about the role of technology and risk, about how we develop these new risk mitigation technologies, be it options or swaps or anything, and that really gives us an ability to feel like we're reducing risk, but often it introduces new risks or encourages us to take bigger risks.
That's exactly where I was going to go. Is there a question around how accurate some of these risk measuring devices are in markets that have gotten fairly divorced from, you know, the t-shirt and shorts of going out and making sure you don't wipe out in a wave and then die?
Yeah, well, I mean, I think one of the challenges is I have another chapter that actually turned out to be quite timely about the movie industry and about how difficult it is to predict what movies are going to be successful. Because, I mean, all these models rely on data. And if the world changed, like, say, post-pandemic, do we have any data that's useful? Because, as I said, risk is a really measurement of uncertainty. And uncertainty is just, we have no idea what's going to happen. Risk is an informed guess of what's going to happen. But if our guesses become less accurate, then, you know, they could honestly lead us astray sometimes.
So dovetail that into the moment that we're in, where a lot of people have come on this show and said there are a lot of risks out there, but right now it's looking better. And oh yeah, every time you've tried to bet against the momentum, you've gotten, in Wall Street parlance, your face ripped off. So at what point do you just sort of ignore the feeling that there is risk out there and lean into it, right? I mean, sort of, where does this leave us in today's moment?
Well, I mean, I'm an efficient markets person. As I said, I write in the book about the, you know, the time I worked at DFA, which really got me working with Gene Fama and Ken French. And I think that is part of the risk management, I guess, science is accepting, you know, efficient markets is just really all it says is you can't predict the market. And all the data you have is what you have, and it's not perfect. So don't sort of think you can time things, but just hope you can manage the risks that you can.
Back into your book, you have McChrystal mentioning, the General McChrystal mentioning his joy in your book, and you put McMaster front and center, not the McMaster of Trump, but the McMaster of battle tactician for America in the deserts of the Middle East. A lot of the people watching and listening to this look at the investment world right now is a war. How do you take war, risk, and uncertainty and bring it over to not losing money in the market?
Well, I think that chapter is about uncertainty, and the only real hedge you have against uncertainty is liquidity. But liquidity comes at a huge cost. So that would be the equivalent of really sort of keeping your money in cash.
Triple leveraged all cash. Continue.
Yeah. So I think, and in war too, and in terms of our military, keeping a flexible military that can go with punches is also incredibly expensive, which is why probably we tend to fall back on that. So I think, you know, you have to think about how much does flexibility under uncertainty matter to you, and how much do you really need, because, you know, there are trade-offs with it.
And there's also a question about how much the broader Wall Street economist makes it into the room of the boardroom of some of these industries and companies that you're talking about. And we've been talking a lot about building in redundancies to avoid supply chain disruptions akin to what we saw during the pandemic. How much is that the risk mitigation kind of technique that an increasing number of industries are turning to, or are they looking to financial instruments and other kinds of perhaps cheaper, more efficient ways?
Well, I think, I'm now working on a new book about our myths about risk. And I think one of the myths I didn't go with, but I was always thinking about, is risk reward. Because I think in finance, it's sort of this central truth that you take more risk, you get more reward, but you risk more loss. And I think the economy is now sort of suffering from sort of forgetting that. Because, when we talk about de-risking the economy or having more redundancies or reshoring, I think people forget that comes with a serious cost. And it could be higher inflation in the future. It could just mean, a less dynamic economy. So it might mean sort of less risk around very particular shocks we saw around the pandemic, but it could introduce new ones or just have slower growth in the future.
Has financialization of a lot of industries, and I'm thinking of, for example, what people say about oil and the oil market, has it distorted the ability to measure risk and reward as efficiently as it used to?
Well, I would expect it make it easier, right? Because we have more data. On one hand, it could, but on the other hand, it also might make it easier and sort of make it easier to measure risk.
Page 5, you dive into and research the Moonlight Bunny Ranch. That's your brothelnomics?
Yeah.
What, pray tell, for radio, TV, and our family audience, can you tell us about an economist, Schrager, walking into a brothel and seeing brothelnomics?
Well, it wasn't what I expected when I started my career. But I got invited there for a story about negotiation skills. And
really?
Yeah. Turns out they have a rather extensive negotiation program, training program, which I went through, which is very helpful.
Do go on.
We'll extend this, blow the break, tell Pharaoh he's not open to the 9. Continue, please.
But while I was going through the negotiation training program, I was talking to all the women about what they charge for different services. And you found that, like any other industry, there's a premium on risk. And certainly that's how services are largely priced in even in sex work. I guess that's what I was exploring there, is really getting a feel on pricing.
Right. Okay. The control room just said, that's enough, Tom. Thank you. Alison Schrager with a really wonderful book. An economist walks into a brothel. You can see it to learn more about brothelnomics as well. It's like Steve Levitt's Freakonomics. I'm honored to say I did the first interview with Professor Levitt at Chicago on Freakonomics, and when we did that interview, nobody knew how big that book would be. Nobody had a clue.
Yeah, I think that's fascinating, by the way. I mean, everybody in their life measures risk and reward in different ways.
Right.
And so when you talk about whether it's sex work or whether it's, riding a 40-foot wave. Yeah, exactly.
Whatever.
It's more visceral kind of risk, perhaps.
Yeah. I'll put this out on Twitter. I'm going to put out Alison Schrager's book, An Economist Walks into a Brothel, with the great Peter Bernstein and Against the Gods as well. Green on the screen, a modest lift to the markets here on a quiet Monday. This week, more than entertaining. This is Bloomberg. Good morning.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. 3 weeks of gains on the S&P 500. Can we make it 4? Payrolls on Friday and some tech earnings later this week. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, tech heavyweights reporting earnings this week. The US payrolls report just around the corner, and first into the hiking cycle, first out. We begin with the big issue, strategic ambiguity.
The strategic ambiguity.
Strategic ambiguity.
We've got to pay attention to central banks.
Bank of Japan was the last one holding.
This is a really small tweak.
Small tweak.
There is no actual line in the sand.
The first signal that they're going to start tightening policy.
The trajectory is towards tightening and comprehensive conditions.
They have this last mover advantage.
Every BOJ meeting is probably going to be live up ahead.
They're looking to do something different.
It's about the next step.
What come next?
Central banks have had difficulty forecasting where we're heading.
If the economy stays strong, central banks might be forced to do more. Whether it's Powell or it's Lagarde at the ECB.
Everything is on the table.
Central banks are still keeping the door wide open.
Joining us now to discuss, Franklin Templeton, Sonal Desai, Jim Bianco of Bianco Research. Great to catch up with you both going into the open and bow, going into a busy trading week. Sonal, I've got to start with you. A lack of clarity from the ECB, a lack of clarity from the Federal Reserve, a lack of clarity from the BOJ. Some people might say it's by design. Is it a good thing?
It's a good thing. Maybe it's time for markets to stop looking to try and anticipate different central banks' next moves and start focusing more on the data. Look, Jonathan, we've had an enormous number of hikes and the economy keeps chugging along. I think this is not pointing towards an economy under threat from central bank hikes, as everyone anticipated. It is an economy which needs to get used, and a market which needs to get used to the new level of central bank rates, which is substantially higher than where we were for the last 15 years, say.
Jim, is the hand-holding over?
I think it is over, and it should be over. I think that part of what you're seeing with this strategic ambiguity with central banks is a bit political, and what I mean is there's no agreement within the boardrooms of these central banks about what they should do next, even though the Fed wants you to believe this with 11-0 votes. And ultimately, they're trying to figure out what their next move is going to be. And I think it comes down to inflation. Is the inflation rate bottoming this summer, and is it going to start up, or is the inflation rate going to continue to head lower? And that will probably be the main driver of what comes next.
Well, Jim, we know what you think. You think it picks back up, don't you?
Yeah, I do. I think that we're at the low on a year-over-year basis now. And it's the base effect. If you look at last July, it was 0, was the inflation rate, was 0.2 in August. With just the jump in gasoline prices in the last week or two, we should easily jump over that. We should be looking at 3.4, 3.5 on the year-over-year inflation rate by, say, Labor Day, if not into October. And that should be enough to at least get the Fed to consider more rate hikes.
So, Noel, where are you on that? The prospect of inflation picking back up later this year?
I think I actually have a lot of sympathy with that view on headline rates, but what I will say is I just don't see core inflation coming substantially below, say, 4.5% as we get to year end. And that's why I actually think additional Fed rate hikes are definitely still on the table. I don't think we can rule it out.
Is there any evidence, Sunil, from your perspective, that we are sufficiently restrictive? When you hear the Fed chair talk about getting to restrictive levels and keeping them those rates there for longer, do you even think they're there yet?
Honestly, I would argue it's not so clear. Look, for right up to the pandemic, if we look at that entire period, we've had real rates of about 0.5%, and there's a lot of people who believe that neutral Fed funds rate, nominal rate, is around 2.5%. So 0.5% real rate if inflation was as low as 2%. For over 50 or 60 years before the global financial crisis, that number was closer to 2.5, which would mean that nominal Fed funds at neutral would be around 4.5. So we are at Fed funds of around 5.5 right now, while inflation is substantially above where the Fed wants it to be. Are we sufficiently restrictive? I'd argue it's at least debatable. And I'm not so sure that we're not going to see changes to the Fed's long-term SEPs on where they see Fed funds going forward.
Jim,
sorry.
No, it's all right. Jim, would you agree with that?
Yes, I would agree with that. I mean, people have looked at the 500 basis point rise in interest rates over the last 15 or 16 months and said, wow, that's a lot, and that has to hurt, and that has to have some kind of impact. But what if the vast majority of that rise has just been to keep pace with neutral? And therefore, the amount of restrictiveness that we've put into the system is not that great. And you could see that with the talk that maybe we're going to achieve the soft landing. The economy is not going to have a recession as we move forward. And that's because even though that's been a big rise in interest rates, it's not that far above neutral, and that might give the Fed room to move more should they feel it's necessary in the coming months or year.
25 minutes out from the opening bell, equities at the moment positive by 0.2%. Lots to talk about with the BOJ, still digesting last week's central bank decisions. Mike McKee has more. Morning, Mike.
Morning, John. Well, I thought I'd start this off with a couple of quotes for you, and I think I did it wrong because it might have been more fun if I didn't put the names on them, and you could guess who said what. In September, there could be a further hike of the policy rate or perhaps a pause. We're in an environment of uncertainty, and we'll reassess the situation and our action on a meeting-by-meeting basis. That was, of course, Christine Lagarde in Le Figaro today. But it was just a week ago that you had Jerome Powell saying it is certainly possible we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. Twin sons of different mothers, except one's a daughter and one's a son, but basically the same message for everybody. And you can see what's happened over the last couple of weeks. You've got the terminal rate, the highest rate that the market thinks these people are going to reach, going up, and then flattening out, because the volatility has dropped out of it since nobody really knows which way they're going. And for either central bank, it isn't much of a move. Now, to get back to what John started with, the Japanese central bank is in a completely different position. They, on Friday, and you can see what happened, they raised the band for buying and intervening in the 10-year yield curve control, and yields went way up. And then this morning, they breached the 60 basis point level, and the bank stepped in to push them back down again below that. They say they are not getting ready to end yield curve control, but the market doesn't think so, and they're testing them. And the reason this all matters, of course, is if the Japanese yields start rising significantly, like the rest of the world, then money will flow back to Japan, out of the US, out of Europe, and that will have an impact on markets and rates here. So everybody keeping an eye on the Japanese. They're the ones who are not doing strategic ambiguity now, but the market thinks they are.
Lack of clarity around the thresholds there, Mike. Did you sense it was the pace of the move from Friday or the level, the threshold, 0.6%?
My guess, it was a little bit of the pace of the move because they want to tell the markets, don't test us. We're going to come in if you get too far ahead of yourself.
Mike McKee, thank you. Jim Bianco, I want to come to you on this. We still have yield curve control, kinda. There's a target rate with a ceiling of 0.5. At least they've told us it's not going to be a rigid ceiling. They might let it go beyond, but they will come into the market every single day and buy at 1% if they need to. Then they step into the market at 0.6%, Jim, and we're all scratching our heads. What is the policy? What's the policy, Jim?
We don't know what the policy is. You're right that the 0.5% has now become a reference point. It's not become a ceiling, whatever a reference point means versus a ceiling at this point. I think the Bank of Japan is kind of stuck. They've had this yield curve control policy since 2016. We've completely lost the narrative on it. Remember, the target is 0. And then they just keep expanding the band, and the upper end of the band becomes kind of the new target. So that's what I mean by that they've lost the narrative on it. And so they're trying to figure out what to do with it next. And they're also afraid a little bit about letting it go because of the amount of indebtedness that the Japanese economy has, that if the interest rates were to start to really shoot up, it could have a big impact. And just to reiterate something Mike McKee said, too, let's not forget that the Japanese are the largest owner of U.S. treasuries in the world, more than China. And if their rates become competitive with U.S. rates or the rest of the world, and money flows right back into Japan, then you could definitely see it coming out of U.S. treasuries, and that would be a net negative for the U.S. market.
Let's build on that, so I'd love your thoughts on it. There are vulnerable parts of this bond market with a big presence of Japanese investors. How vulnerable are those parts of fixed income?
I think that, honestly, this is a part of the reason that I have been arguing for a while now that U.S. 10-year yields are on their way up. This is one element of it, but even without the Japanese, and I get it, it's constructive ambiguity, but I totally agree with Mike McKee. It's a lot more to do with the pace of that 10 basis point move rather than the direction. I think they do have inflation. It looks very much like they might sustainably get their inflation target for the first time in almost 4 decades. And so I think we need to be prepared for Japan being the last to the party, but coming to that party, and probably sometime, maybe next year, beginning to think in terms of raising rates. And absolutely, it has an impact on U.S. treasuries, especially if the Fed is not in a position to start cutting. And I don't think it's going to be in a position to start cutting soon. It's going to be into next year before we can even start thinking about rate cuts.
It's taken a long time to get to that party. Sonal Desai, Jim Bianco, you guys are really sticking with us. This quote from Governor Kuroda, I'll give you the date on it in a moment, if you missed this. This is from minutes from a meeting a long time ago. We should avoid deploying our firepower in incremental steps and aim to achieve the target at the earliest possible time. Specifically, I have about 2 years in mind. 2 years in mind to get inflation back to where they wanted it to be, to do all that easing. That quote was from Governor Kuroda of the BOJ back in April 2013, more than 10 years ago. And as Sonal pointed out, we've been doing this over in Japan now for decades, trying to figure it out. You see it in dollar yen this morning, weaker Japanese yen as the BOJ steps back in. Dollar yen at the moment, 142.43. Let's get you some movers going into the opening bell. Here's Abby.
John, let's start with the shares of SoFi, because after a very choppy pre-market morning, we do actually have the stock rising significantly at this point after the online bank raised its revenue guidance for the year, citing benefits from deposit growth and lower funding costs on loans. Right now, up 13%. Palantir also up sharply, up nearly 6%. I suspect this has something to do with tech bull Dan Ives last week initiating on the stock with an outperform rating and a $25 $5 price target, suggesting that more than 20% upside potential is available from here, plus AI being attached to this name. And then finally, to the downside, Ford, Jefferies has cut their view to a hold. They see a worse than expected losses on electric vehicles. It's interesting, into today, the stock up about 20%, the same as the S&P 500, so basically performing as is, but it looks like today Ford is set to take a dip, John.
Abby, thank you. More on that call a little bit later in the program. Coming up, first into the hiking cycle, first out.
We think the big opportunity right now for the next 6 to 12, 18 months is in emerging market equities and commodities. Emerging markets are going to lead the next cycle in central banks, which is rate cutting, right? We're at the end of the rate hiking cycle in the West.
In EM, the rate cuts are here. That conversation up next.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
The signs of deflation are not there in China. What concerns me more is that of a deep recession in China that might have impacts on the stability of the regime, on the stability and constancy of economic policy. The problem with their growth engine is that they've run out of really lucrative investment projects, and that's causing their growth rate to slow down.
It's Carl Weinberg of High Frequency Economics, the latest there on China. Elsewhere, the first to hike, the first to cut. As the Fed and the ECB gear up to hit pause, EM central banks are gearing up to reduce interest rates. Latin America shifting to looser policy, with Chile delivering a 100 basis point cut. Brazil expected to follow later this week. This as China is looking to stimulate its economy by removing consumption restrictions. Equities across emerging markets are threatening to break out. Damien Sasser of Bloomberg Intelligence joins us now. Damien, these were the original front loaders. They got out there first, and we're starting to see the cuts already.
That's exactly right. Well, I mean, it's because their economies are weakening, Jonathan. That's the real story here. It's not so much that, you know, they can cut, and believe me, in Brazil at 13.75%, that's the Selic rate now. They've got plenty of room to cut, but it's the fact that their economies are just not growing. So this is where the rubber meets the road. So I'm not an EM equity guy, but with response to the commodities and EM equities, which are typically late cycle bets, it's interesting to hear some of the other guests talking about how that's going to lead us out of where we are, and it's going to be the beginning of the news cycle. I don't know if I'm so convinced of that, but EM equities certainly, on a valuation perspective, appear relatively cheap to their DM counterparts.
Damien, just how much progress have they made on the inflation story in the places like Chile, where we've had a cut, Brazil, where we're likely to get one later this week?
So Latin America's made a lot of progress. It's Eastern Europe which really concerns me. Hungary's already started the cycle. We're starting to see inflation come off in the periphery. I'm talking Poland and the Czech Republic, but it doesn't seem like those central banks are so willing to cut. In Chile and Brazil, they certainly are. They've gone a long way. And so, yeah, you know, it remains to be seen. My focus is going to be more on the Asian high yielders, Indonesia, India, and the like. They have room to cut, and their economies are weakening pretty significantly also. I mean, so, and certainly you mentioned China. You know, if China continues to kind of fall off a cliff here, you know, that's not going to be good for the Southeast Asian bloc. And so, yeah, I'm going to be looking at those economies very closely.
Damon, I'm calling the situation in China a shift in posture. It's an easing posture. They're saying the right things. They're going to start to do those things. You're going to see big moves out of that country.
I mean, Jonathan, we've been waiting for Godot for so long, and it really isn't about the supply side. I mean, Jonathan, I'll give you a stat for you. Their fiscal deficit to GDP is actually shrinking. So all the talk about extending restaurant hours, you know, removing restrictions on second car buying, all the things they're doing on the property sector, if they can't still demand, then we have a big problem here. So, you know, we're hoping that stimulus, we're hoping that rate cuts are going to do it. But without putting cash in the hands of households, you know, the verdict is still out.
Do you remember when we used to talk about global synchronized growth? Do you remember that? Everything was synchronized. What about now? How unsynchronized is this policy cycle from EM to DM?
And it's all about interest rate parity. It's all about interest rate differentials. It's all about everything we've talked about with the yen and the carry trade. I mean, you look at Brazil, you look at Chile, you look at these double-digit yielding economies, and you say, wow, I can carry so well in them, and especially on a volatility-adjusted basis now with the VIX coming off. So, you know, I can see I can see the value there. I can see the attraction there. But there are some real problems that are facing these economies, and you rightly point out China. China's now a funding currency, right? The China yuan is now used to fund taking risks in places like Brazil. It was the other way around not long ago, and so this is the paradigm we now live in.
Damien, thank you, sir. Back with us for some final thoughts. Sanal Desai, Jim Bianco. Sanal, it wasn't so long ago we were talking about China reopening. That economy was going to do wonders this year and support global growth, particularly in places like Europe. It's the end of July and we're talking about easing. What does that tell you?
Well, I think there was too much expected from China. It's been slower, but I'm probably not quite as pessimistic. I'm not an equities person, but I'm looking at from the fixed income side. I do think precisely because China's running a relatively small fiscal deficit, there is room for them to ease. That's a big deal. And by the way, that's true globally for emerging markets, not every single one, clearly, but emerging markets in general simply did not loosen their purse strings as much as developed markets did. So there is scope to actually assist on the growth cycle in EM, not just from monetary, but to some extent from fiscal, which DM don't have. So I would say I wouldn't be throwing in the towel on China yet. I still think that as they get a little bit of support off the ground, the rest of Asia stands to benefit from this particularly.
Jim Bianco, do you think the policy mix is more favorable in emerging markets right now?
Well, it is more favorable because, as Damien said, you know, their economies are weakening and they're trying to respond to it, and they're already starting with double-digit interest rates. But of course, when you talk about emerging markets, the biggest one is China, and I'm a bit more pessimistic about China. Just, Jonathan, what you pointed out a minute ago is in January, they did probably the biggest stimulus in the history of China. They ended zero COVID and sent hundreds of millions of people back to work, and that didn't do it. And I don't know if extending restaurant hours and cutting interest rates a little bit is going to really matter at this point if what you did in January did not really get the economy going. And so China is definitely going to lead that emerging market slowdown that we've seen. And I suspect you will continue to see those rates in emerging markets continue to get cut as we go forward.
Jim, are we seeing the early signs in China specifically of the country grappling with a balance sheet recession?
I think we are. I think we're seeing it dealing with a lot of issues, not only with a balance sheet recession, of course, the property market is still in trouble, but also in trying to figure out where China's going to go next, where they're going to lead, where they're going to follow. They're kind of in a flux and in a transition, and it is showing up in their economic growth.
Big one-week gain on Chinese equities, Jim. You just wonder then how much longer that can last.
Yeah, but you also keep in mind that the big one-week gain has come after many, many months of their stock market struggling. So their stock market is at a much higher volatility level, and it's hard to say whether or not that gain has been driven by some kind of reassessment about their future, or if it was just an oversold bounce.
Under the radar, there's been this rally in commodities as well, looking at Brent crude back to about 86, WTI up to 81. So, Noel, how closely are you looking at that right now, and what kind of signal are you taking away from it?
I think I'm taking away that same signal, which is that everyone anticipated a significant slowdown on the back of developed world hiking, and instead it hasn't happened. And now we're at the cusp of emerging markets beginning to cut and start re-stimulating their economies. So it doesn't surprise me that much that we're seeing crude respond to that growth simply hasn't slowed down the way people were anticipating even a few months ago.
So, Noel Desai, Jim Bianco, to both of you, thank you. To set us up for the trading week still ahead, going into payrolls on Friday, 200K the estimate, by the way, and going into earnings on Thursday from Amazon and Apple. At the moment, on the S&P 500, about 7 minutes away from the opening bout, equities positive by 0.2%. Coming up in the morning calls and later, Citigroup's Stuart Kaiser making a case for sticking with big tech ahead of those results from Apple and Amazon later on in the week. That conversation up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
5 minutes away from the opening bell. Equities positive here by 0.2% on the S&P. On the Nasdaq right now, up by 0.1. 3 weeks of gains on the S&P 500. Last week, a decent week of gains. The outperformance, though, a comeback for the Nasdaq. The Nasdaq 100 last week, up 2%. That's the price action. Here's some morning calls. First up, Goldman, upgrading Chevron to buy 187 price target, highlighting the stock's attractive valuation and improving free cash flow. Next up, Piper Sandler upgrading Wayfair to overweight, pointing to strengthening traffic trends and ongoing market share gains. And finally, Oppenheimer downgrading General Electric to market perform, seeing limited upside following the stock's monster rally so far this year. That stock is positive by 0.3%. Coming up, Apple, Amazon headlining another busy week for tech earnings. That conversation up next with Citigroup's Stuart Kaiser, who is constructive on growth equities and sees further upside in this equity market. Your opening bell is up next.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Turning to autos, Jefferies downgrading Ford to hold after the automaker announced the latest performance. We appreciate efforts in disclosure and accountability, but also note that there's no apparent change to their strategy. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, you can really feel the emotion in this sell-side report because you had this Jefferies analyst writing that they're downgrading Ford to a hold with, quote, a heavy heart. And of course, this comes after Ford reported those worse than expected losses in their EV business. Remember, the company said last week that it expects to see losses from EVs hit $4.5 billion this year. That's up from a previous estimate of $3 billion. And CEO Jim Farley also said that pricing pressure has increased dramatically in just the past 60 days. Now, the company also said it's going to need another year to meet its annual production rate target of 600,000 EVs. And while Jeffrey said that the company's decision to slow the pace of unprofitable EV sales to safeguard its returns is a sensible decision, it's a setback nonetheless. And hopefully Ford gets back on track for the sake of this analyst. You take a look at shares right now, currently off by about 2.2%.
Katie, is that how you downgrade and maintain access to management
there you
at the
go.
same time? Is that by design? Maybe. Katie, thank you. I think we all hate that, don't we? Let's stick with the autos. Jeffrey's also downgrading Carvana, cutting its rating to underperform and writing this. This one less emotional. Fasten your seatbelt. There's still a rough road ahead. Transitory tailwinds are inflating near-term profitability, which will start abating in the coming quarters. Jeffrey's becoming the fourth brokerage to turn bearish on this stock this month alone. Elsewhere, let's get back to earnings. SoFi Technologies topping analyst estimates and boosting its outlook. The CEO saying this: as a result of this growth in high-quality deposits, we have benefited from a lower cost of funding for our loans. Shanali has more. Hey, Shanali.
Hey, hey, John. I'm Shanali. I'm very sorry. When you look at SoFi, for example, you went from the banks to the non-banks and the neobanks, and SoFi, which bought a bank, and they are finding now a big boon from that. Net interest income doubled in the period, and then you also have a stock that has more than doubled this year, also seeing gains this morning after you see SoFi and its former Goldman CEO, Anthony Noto, now diving into the consumer, diversifying away from student loans into different kinds of banking products. And he has raised his guidance multiple times over the past year. This is a stock that took a serious beating last year, really on the rebound this year. Among the savings accounts that you see out there, they do offer one of the best rates, more than 4.4% on a savings account. So they're bringing in those deposits. They are showing that even then the business model does work as margins are improving, and again, raising their guidance.
Abby called me Joe last week. Shanali, don't worry. I can be Shanali today. Thank you, Shanali. Thanks to Bloomberg's Shanali there. Tune in for the SoFi CEO at 12:30 p.m. Eastern Time on Bloomberg Technology. Look out for that conversation a little bit later. And finally, shares of Adobe are rallying at the opening bout. Morgan Stanley upgrading the stock to overweight with a street high 660 price target. The analyst writes in this: greater clarity on AI-enabled products and its roadmap increase our confidence in re-accelerating the cloud growth engine. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Adobe's given up some of its early gains in the session, but still higher by 2.7%. That 660 price target call from analyst Keith Weiss assumes a 25% gain in the shares over the next 12 months or so. Morgan Stanley also lifting its longer-term EPS and revenue growth expectations. It's interesting because in the note, they admit that Adobe was kind of late to the party when it comes to the generative AI play. But what we got in June was a sense of the strategy. It is a subscription-based service for broadly consumers, a flat rate for business customers, but also being able to make money on the copyright services relating to image generation from generative AI is an example. That street high price target of $660 a share, if those gains are to materialize over the next 12 months, it would take Adobe pretty close to the record high it hit in 2021, $688.37 a share. Just a reminder that this is a company that kind of reports later in the season, so we won't hear from them in a while, but we did get that outlook update for both full year revenue and profit in June when they outlined strategy. The average 12-month analyst price target on this stock, $555.70 a share, right now up by almost 3%, trading at its highest level since January of 2022.
Forget Adobe. Let's get to the two big players Thursday. Ed, Amazon, Apple. What's the street looking for?
Yeah, Amazon, you know, it's a continuation of the Andy Jassy story, undoing the pandemic era investment, going back to the cash cow profit of AWS. But you'll see the news this morning on them being very aggressive in delivery and fulfillment times. And then Apple, iPhone is king. You know, we've reiterated this time and time again. The Vision Pro is very distant from being meaningfully revenue generating. Tim Cook always hesitant to be an economist on the call, so it lives and dies by the performance of iPhone globally. And then also some surprises potentially in Mac in markets like China, where the consumer seems willing to spend on that premium tier. especially for products that are new to that market.
Huge week ahead for Bloomberg Technology and the team. Ed, thank you, sir. Ed Ludlow, Caroline Hyde, midday, Bloomberg Technology. Do not miss that. And then, of course, later this week is the big one after the close. Remain of the team will break that down for you. When we get earnings on Thursday after the bow from Apple and from Amazon. City Stuart Kaiser making a case for tech stocks, writing this. The prospect for softer data into year-end is a key reason we see a cyclical rotation as unsustainable. We keep tech and growth stocks as a core equity exposure. We maintain a tactical upside bias. Stuart Kaiser joins us now. Stu, wonderful to catch up with you, buddy, as always. Let's just start with the upside. Briefly, what underpins that further upside from your perspective?
Yeah, Jonathan, good to see you again. I would say it's, pretty basic, actually. You've had, significant positive surprise in U.S. economic data. The Fed seems comfortable backing off a little bit. Inflation's been, easing. Last print was pretty friendly, and our economists expect that to continue for the next couple of months. So I think you put all those three things together, and it's just a good path for risk assets to continue to move higher. So we remain, tactically bullish on the markets.
To capture that upside, though, you're thinking about growth equities, big tech players. You're not thinking about cyclicals, Stuart. What separates you from, I would say, the pack that is increasingly becoming consensus?
Look, I think our view on tech is exactly what you've seen this earnings season, which is earnings growth is still relatively scarce. If you look at the drivers of performance this year, EPS momentum or positive revisions to consensus numbers have been a key driver of returns of the leadership of the market, and we think that continues. We're not necessarily negative on cyclicals. I think through the options market, you can get exposure to banks or to energy to that upside trade just in case you need it. But I think the core view remains tech and growth, because I think, growth is still scarce both in the U.S. and globally, and it's large cap U.S. equities which have that growth. So, we're not ready to pull the cord on that one quite yet.
As you know, lots of people talking about the weightings of the NASDAQ 100 and how that's going to shift. 11% of the NASDAQ 100 is still Apple. More than 5% of it is Amazon. You add up the two, and you've got some pretty big weightings from two names, Stuart Kaiser. Some people complain about that narrow leadership, that dominance, unsustainable. Are you taking a different view on things?
Jonathan, it's just not something we're that stressed out about. I mean, I would agree, obviously, there's a lot of concentration in U.S. equity markets now, and more importantly, I think the leadership has been concentrated in a relatively small number of stocks. But if you look back through history, this isn't, too abnormal. There are generally, it's generally either a sector or a small number of stocks who are contributing, the bulk of the returns in a given year. This year it might be a little more concentrated in a small number of stocks, but I don't think this is, just completely out of the ordinary historically. It's kind of the beauty of U.S. equity indexes, right? That you're continually dynamically rebalancing into the best and brightest companies in the world. So, yeah, it's an issue. I think it's on a lot of people's radar, but it's just not something right now that's going to make us change our tune on that part of the market. I would say it's a similar argument to valuation. It's potential energy. It's something you need to worry about from a risk-reward perspective, but you need a catalyst to release that energy in either the upside or downside direction. And currently, we just don't see a driver or a specific event that's going to release that in a negative way. So, yeah, look, it's on our mind. We get asked a lot about by clients, so of course we have to think about it. But again, I don't think historically it's that as abnormal as people want to make it out to be.
Just going through the calendar for the week ahead, Stuart, that'll be the focus for Thursday after the bow. Those numbers come through, Apple, Amazon. Friday morning, payrolls, 8:30 Eastern time. A number that we used to see a lot of, the estimate, 200,000. Stuart, do you think the data itself is becoming less volatile? And I noticed in your research, could you walk us through the relationship between that and the volatility in the market?
Yeah, for sure. I mean, I think both the realized economic data, whether that's payrolls or, in this case, more importantly, inflation, has obviously come down considerably. And then if you also just look at the volatility of real yields, of nominal yields, of federal funds, the volatility of all those metrics has declined. And if you look historically, when those macro elements are very volatile, then it's going to spill over into equity markets. And I think, the reverse of that is what we've seen this year, is realized economic data has become less volatile. The macroeconomic indicators have become less volatile. And that's allowed equity markets to become more investable in our view. And we've touched on this a couple of times, that if you trim the tail risk and you reduce the range of outcomes to something that's a little bit more manageable, effectively add clarity to the market, then equity markets are going to typically perform positively. And we think that is happening in the background, and we expect it to continue to happen going forward.
Do you find that supports risk just in general, or does it favor one part of the market more than others?
I think it supports risk in general. I mean, I think it supports credit markets, supports commodity markets, and definitely supports equity markets. But equity markets in particular, what you're looking for is clarity or predictability, right? Equity markets can work with an inflation rate of 4 or 5%. They can work at an interest rate of 4 or 5% historically. Once the market adjusts to that expectation and can invest in it appropriately, and I think the issue last year was yes, the change, the change in the level of yields, but more importantly, just the uncertainty around it. Last year you're talking about 75 basis points, 100 basis points, potential hikes at a given meeting. Now the question is, are we skipping a meeting? Will you get an incremental 25 or 50 basis points over the next 3 months, let's say? And I just think that's a very big difference in investment environment, relative to last year.
Enjoyed the research yesterday evening. Thanks again, Stuart. Thanks for being with us. Stuart Kaiser there at Citi, looking for further upside here in the equity market, going into big earnings later this week. Your market at the moment, about 13 minutes into the session, equities positive by 0.2% on the S&P 500. Earnings on Thursday, data on Friday. Coming up, trucking giant Yellow shutting down after nearly 100 years in business.
I am pretty worried that this economy is going to slow meaningfully in the coming quarters. Everybody, of course, would like to have a soft landing and not have job loss and have this continue. But the initial conditions are a little tough.
The outlook for jobs in America, up next.
Names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Overall,
I think that the inflation outlook is quite positive, that it should be slowly diminishing from here. But again, we've just continued to be surprised by the dynamics of this reopening economy, and so we can't prejudge it. We have to let the data actually guide us.
Neil Kashkari there of the Minneapolis Federal Reserve going into their next decision on September 20th, I believe. That's where thousands of jobs at stake as US trucking giant Yellow tells workers it's shutting down, putting roughly 30,000 jobs in jeopardy as trucking companies try to balance slowing demand and rising wages. The job loss is coming on the heels of the union winning large pay increases from UPS and another big payrolls report coming on Friday. Let's get your team coverage. Bloomberg's Anne-Marie in DC, Michael McKee here in New York. AMH, the reaction from Washington to that dispute last week was somewhat of a victory lap. This morning, I imagine anything but.
No, it's not a victory lap, although we did hear from Jared Bernstein, the chair of the White House's Council on Economic Advisors, talking to CNBC. And he said this is more about Yellow and less about a market indicator for the economy. And he did repeat what the president likes to say a lot, Jonathan, and that's the fact that he says he's the most pro-union labor president in modern history. The optics, though, could be muddled for the president, given the fact that Yellow reached out at the end of June to the president in a letter. And this is what the company had to say. Despite support from your administration, these efforts have proven unsuccessful at getting both sides to the table to discuss a way forward. The company blamed union intransigence, Jonathan, that Yellow's business plan has been frozen. There's another political aspect to this as well, Jonathan. It might not bode well for the former Trump administration, and Trump, you know himself, is a candidate and potential nominee for the 2024 election. Under his administration, Yellow got a $700 million loan on a national security designation that now Congress is saying Treasury and the Defense Department made missteps in that designation and giving that loan.
Mike McKee, are we learning loads about Yellow or a fair bit about the labour market? The more I read about Yellow, the more I believe it might be the former and not the latter.
Well, I think you're right, John. Yellow does have some unique problems that led to its demise, although certainly the labor issue is a big one as people try to get their money back from the inflation of the last couple of years. But here's the good news for at least the U.S. economy. There are a lot of trucking jobs open, over 600,000 according to the last JOLTS report. We get another one on Wednesday. And if that's the case, then the 30,000 people who are losing their jobs should be able to get new jobs fairly easily. So this might fade as a political issue. The UPS strike would have been much worse had they not settled, because we were talking hundreds of thousands of people there. But the Yellow company is what they call a less than truckload company, where you don't have to fill the whole truck if you're a shipper. And there are a lot of others in that space. And the feeling is they can pick up the overall load, especially since less than truckload loads have started to go down. Yellow had gotten into a lot of debt problems because it bought a number of other companies, especially some that were unionized, and their wages were higher than the rest of the industry, and their overall costs were higher than the rest of the industry. And when the Teamsters came to them and said it's time to give us a raise, it basically boils down to they didn't have the money.
Mike, I'm looking ahead to the data on Friday. Payroll still looks pretty robust, 200K the estimate, unemployment expected to stay at something like 3.5%. Is that widely, more broadly, the expectation?
That's the broad expectation. The real focus has been on the number of jobs created and the fact that the market hopes is slowing, although we've most months come in ahead of what the market thinks. The unemployment rate, 3.6%, supposed to be unchanged. That doesn't match up with what the Fed has forecast. So it will be an interesting data point, but we do have another jobs report coming up before the next Fed meeting, so that will tell us more about what the Fed might do.
2 jobs reports and 2 CPI reports between the last Fed meeting and the next one. AMH, thank you as always to Mike McKee as well. Busy week for Mike McKee. Anne-Marie, hoping to take August off, but ultimately you can't get away from the legal issues at the moment down in Washington, and there is a GOP debate coming up at the back end of August, so the political campaigns pick up a little bit too. Your equity market more broadly on the S&P 500, positive by 0.2%. Let's lift the lid on the index and get you some sector price action. Here's Abby.
even though that gain is very small, John, we have most S&P 500 sectors trading higher, so lots of breadth on the day. 10 of 11 S&P 500 sectors higher, led by energy, up 1.8%. We have oil firmly above $80 a barrel. Some analysts expecting it to go sharply higher than utilities. Real estate are also near the top. Interesting, because yields aren't doing all that much. On bottom, healthcare being weighed on by J&J. Now, the month of July, John, it's the second month in a row that all 11 S&P 500 sectors are higher, at least right now. Real estate is the worst, down up 1%, but it looks like that will be the case, again, signaling breadth. As for some of the top, communication services up 7%. You also have that energy sector at this point taking out communication services for the top spot, and then financials and materials. So the breadth that everybody's wanted all year long, it's starting to creep in a serious way, John.
We're seeing it happen, Abby, that's for sure, after the dominance of big tech for most of this year, that broadening out that the equity market bulls were hoping for, wishing for, and the people who've been trapped in money market funds and pouring into the equity market are perhaps looking for. It's a quiet start to the week stateside. It promises to pick up as the week progresses. Your trading diary is up next.
Of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
25 minutes into the session, advancing by 0.1% on the S&P 500, pulling back just a little bit on the Nasdaq 100 by, let's call it a tenth of 1%, following a really decent week of gains on the Nasdaq just last week, encouraged by the numbers from Alphabet, Google, from Meta, of course, Facebook, and looking ahead to the results from the likes of Apple and Amazon later on in the week, after the bell on Thursday. That's the equity price action. Let's get to the trading diary. Packed week coming up. Earnings from Caterpillar, Uber coming tomorrow, plus the JOLTS report and ISM manufacturing data. We'll get Qualcomm earnings on Wednesday ahead of Apple and Amazon on Thursday, plus a Bank of England rate decision as well. And finally, the US payrolls report to round the week out on Friday morning at 8:30 Eastern time. The estimates so far, the median estimate in our survey, and bear in mind that's a moving target as more estimates start to change and more estimates start to come in. The estimate at the moment, 200,000, and unemployment expected to remain around 3.5%. Much to look forward to. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Tonight, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. Tonight at 6 p.m. Eastern with replays all weekend.
Could face bigger challenges next.
It was going to keep rating World Cup.
This is a 3 as the economic picture down. The OK is getting ready to make a decision.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Matt Miller, you got it. He's off. He worked 2 days last week in a row, John. So let's be fair. 2 days in a row.
That's rough.
So we're giving him the week off to go to London, to Europe and decompress. So good for him. Not to worry. Simone Foxman sitting in for Matt, so we are more than ably covered there, so we will have some good stuff. Coming up, Danielle DiMartino Booth, Chief Strategist and CEO at QI Intelligence. She'll be joining us. And then we're going to talk some stocks with some of Bloomberg Intelligence analysts. Mandeep Singh on the tech. We've got Apple coming up this week, Amazon. Poonam Goyal is also going to join us. She covers the e-commerce and the Amazon. So we're going to tie all that technology and retail stuff together, so that'll be fun. And then, John, I know you're a big salad person. Jonathan Neiman, CEO and co-founder of Sweetgreen.
I'm so excited for this one.
I know. He's going to be in here, and they had some Q2 earnings, a little bit of a miss there, but we're going to take a look for the outlook of that company. So all that coming up in this hour. But first, let's start off, John Tucker, and get a Bloomberg Business Flash.
Right now, the major stock averages, Paul, they are mixed to unchanged. S&P 500 down a point. The Dow Jones Industrial average 14 points higher. NASDAQ 100 right now 31 points lower. And after Friday's nearly 2% surge, big tech earnings are going to once again be the theme for markets. Apple and Amazon both scheduled to report quarterly results after the close Thursday. The rally in stocks still hasn't tempted economist Dennis Gartman, chair of the University of Akron's Endowment Committee.
I'm surprised, I'm shocked, I'm stunned, and I'm wrong. But am I going to go and be a buyer of stocks at this level? No, it's way beyond anybody's wildest imagination as to where stocks could go. and I will stand on the sidelines and watch from the sidelines.
As crude oil prices rise, ExxonMobil, best performing individual stock in the S&P 500, accounting for most of the points right now. One of the big drags that's coming from Microsoft as well as Johnson & Johnson. Speaking of Amazon, they also say they're going to double the number of U.S. same-day delivery facilities. And Political reports the Justice Department could file an antitrust suit against Live Nation and Ticketmaster by the end of the year. The company's fees coming to the attention of the White House.
The DOJ had their chance when we put that deal
Well, they're going to do it again.
All right.
What was the last concert you went to? And can I ask you what sort of in the ballpark what you paid?
No, but I'll tell you what. I just bought Eagles tickets.
Yeah.
All in to get in the door. And I got some decent tickets at the Garden. But this is a bucket list. This is a bucket list. $400 for each ticket. But I'm in the door. I'm going to see these guys. This is it for them. So it was worth the money.
This is it for the Eagles?
This is their going away.
It for some of the Eagles members too.
Yeah,
dead.
I saw the Who's Left tour. You know.
Oh, Simone.
Yes, this is bad. All right, but all my guys, they're doing their.
I love it as a millennial in the building. I mean, you got to respect for all the.
So,
classics.
Matt Miller went to the Fish on Friday before decamping for Europe. So the concert business is alive and well, and you can invest in it by buying Liberty or buying Live Nation.
Gotcha. All right. Anyway, that is your Bloomberg Business Flash, Simone and Paul.
All right, John Tucker. It's all good
there.
Yeah, we got a little off the beaten path, but yeah. Well, the big thing is now. Did you see Simone Foxman? Did you see
Taylor Swift?
T Swift.
I did not, though. I am a
Over
Swiftie.
$1 billion in tickets so far.
Insane.
Amazing. My daughter saw it, and it was just awesome.
I'm jealous.
So anyway, but the concert business. I mean, this revenge thing, going out. And if you're an act, the only way you really make money, unless you're Taylor Swift and you make money off your recorded music, is you have to tour.
You have to tour. But, this kind of brings up this questions that we're going to be dealing with all of this week, though. How strong is the consumer really?
Yep.
I was talking to Diana Bravo on our consumer team, and she wrote a story about how, the airline's starting to feel that weakness.
Yep.
How strong is the consumer really? Has everyone done all the revenge tourism, the revenge entertainment? Yep. Are they still going to buy stuff?
Yeah. Again, my flying strategy until further notice is I'm only flying if somebody pays me to fly.
I heard this one.
Yeah. So no more of this just kind of going somewhere to have fun. If you want to send me
so you have to find a reason to get yourself sent to Europe,
I mean, the industry is a
France.
disaster. The airports are a disaster. I don't need that anymore. But Live Nation, by the way, just to go back to LYV is your ticker. Stock's up 28% year to date. It's got a $20 billion market cap. Live Nation owns most of the concert venues around the world, most of the promoters around the world. And they also own this business called Ticketmaster. So how about that?
So a good business to be in if you are in the revenge entertainment.
Yeah, but if you're a consumer, maybe not. All right, let's see what's happening in the markets out there. John was just reporting, kind of not much happening there in terms of the indexes, but looking under the hood, and we can do that with Carmen Reineke. She covers all the equities markets for us. She joins us live here in our Bloomberg Interactive Broker studio. So, Carmen, what are you looking at here in the market this morning?
Yeah, a few interesting movers. The first one we're looking at is SoFi Technologies, ticker SOFI. It's up about 21% today, which is the most since August of last year, so almost a full year there. It comes after it reported earnings and boosted its adjusted EBITDA guidance for the full year. So looking like it's going to be doing better. Analysts said it was a really positive quarter for the company, and they liked, that their second quarter adjusted EBITDA also beat estimates, as well as them saying it's going to do better.
A 52-week high for the stock. I'm just clicking on my chart, but it's not an all-time high, so it's coming back. But it is a 52-week high.
But what's interesting about this is that we're seeing this strength in this boosted revenue forecast, maybe despite or maybe because of the fact that all these student loan payments are. How does that interplay?
Yeah, so SoFi was one of the companies that actually I think is a beneficiary of payments starting again. So yes, the fact that we're going to see these payments starting again and that cancellation is still really up in the air, I think is a benefit for this stock.
When does that happen? The loan payments?
The payments start again in September or October.
Okay.
I should know
that.
that
I think they
better than I
do. Accumulating interest in September and then October.
Yes.
So do those payments started?
So that has been suspended really since, I guess, the kind of beginning of the pandemic?
3 years.
Wow. So that's been a real benefit for young people with student debt.
And there are all, well, I mean, and older people too. I mean, there are all these concerns that having to go out and pay student loans again is going to weigh on consumer spending, and that obviously has an impact for lots of different companies. Karen, what else are you looking at?
Yeah, so another big one this morning, Johnson & Johnson is down 3.3%. It's the biggest intraday decline in a few months. What happened here is a judge dismissed a case saying that basically the company can't press some people that are suing it for cancer to drop their lawsuits and accept a settlement. So this is a big overhang for the stock. They still could have, billions to pay out because I think this is the talc settlements.
Yeah, I'm just looking at the research from Bloomberg Intelligence, Holly Fromm, who covers all this litigation stuff. J&J and its subsidiaries repeat failure to resolve talc lawsuits through Chapter 11 could mean that it likely must pay significantly more than the $9 billion that had offered in bankruptcy. Wow.
And it's interesting because some analysts are saying that, this should be expected. This has been an overhang for the stock for a while. But others are saying, there's still liabilities here. It's still unwinding.
Yeah, it's I don't know, that's a big number, but it's got a market cap of $435 billion, so put it in that context maybe.
Exactly. And then another one that we're looking at this morning, Nikola, NKLA, is up 12% on news that J.B. Hunt will buy 13 of its zero-emission trucks. So that's interesting. That's a lift for electric vehicles that have been, sort of forefront, I think, for a lot of people this year. Elsewhere in pharmaceuticals, are seeing two big movers from Citius Pharmaceuticals. That's down a lot, 24%. The company had an application for a blood cancer treatment fail to win approval from the FDA. And then sort of on the flip side, GoodRx is up 28%. I think that's the huge jump for them, the most since 2020. Because TD Cowen raised its rating. It's now a bull, rating to outperform from market performance, saying that it has really great partnerships with CVS, Caremark, and Express Scripts. That's a game changer.
And you mentioned earlier a company that I'm going to call out, Dow Jones and the Wall Street Journal, reporting that Yellow Freight, which is now called Yellow, symbol YELL, is a stock I used to cover way back in the day. Did some deals for them. They're shutting down. This is a less than truckload carrier. Customers are like Amazon and other big retailers shutting down amid financial woes. A sad day in the world of trucking.
Yeah. And this
it's just like almost a 100-year-old company.
Yeah, and it's a story that's been brewing for a couple of days. I think a few of these competing companies like Old Dominion and CNF have sort of been on edge, seeing, okay, will they benefit if Yellow does eventually go under? So it's something that we've been watching for a while.
It's a sad day.
Yeah,
in the world of trucking.
And 99 years old, they were so close.
Yes,
to hitting that Hunt century mark, but just struggling.
Carmen, great stuff. Thanks so much for bringing those names to us, Carmen Reinecke. All right, let's bring on our next guest. We love talking to Danielle DiMartino Booth, Chief Strategist and CEO at QI Intelligence. Danielle, we've now had some time, a weekend or so, to kind of digest what we've heard from various central bankers around the world. I'm sure you've had a chance to kind of coalesce a viewpoint. Anything change for you? What are you really thinking about where these central banks are going, where rates are going, based upon what we learned from some of them last week?
Well, I think at a very minimum, you need to think of rates as going nowhere.
Okay.
And I say that as a minimum. We've only got a 20% probability of a rate hike for the September the 20th meeting. But, this is a big week for payroll data. So, more strength in that area, even if it's very lagged in nature, even if we're seeing massive revisions come out of the Bureau of Labor Statistics. Their birth death adjustment showed a negative 816,000 revision downward in the 3 quarters ended December 31st, 2022. Even though the data seems to be catching up with reality, it's pretty apparent to me, at least, that Jay Powell is looking at backward-looking data for reasons to justify higher for longer. I think that is the goal, and I think that he's going to look for whatever data he can find to justify pressing forward with another rate hike, or, again, at a minimum, staying higher for longer, continuing to run that balance sheet down.
Danielle, this is Simone here in New York. Good morning to you. You talk about this meeting reality, the Fed meeting reality, and how The yellow trucking shutdown may herald the beginning of a sort of bankruptcy cycle. How do you see this playing out? What kind of timeline would you anticipate for seeing more bankruptcies? And then when can kind of the Fed no longer ignore that?
That's a fabulous question because, if you look at BCY Go on the terminal, you'll see that the march of bankruptcies really has not subsided. We're continuing to see bankruptcies roll in at the fastest pace since 2009. I think what the Fed has to take into account, though, right now is headline risk. You kind of had a series of quarters where Silicon Valley was coming out with very splashy headlines, 10,000 here, 10,000 there, and then that kind of went dormant for a while. We really haven't seen headline risk in layoffs announcements, but I think that we're going to see that increasingly going forward, whether you're talking to Chris Williamson over at Standard & Poor's, who is saying that, if manufacturing backlogs remain in contraction as they've had now for 14, 15 straight months, that you're going to start to see manufacturers that are not benefiting from the Inflation Reduction Act, that are not building green new factories. You're going to see layoffs start to come through, and that's exactly what Chris Williamson warned about in the second quarter earnings season. Remember, we're only at the halfway point in this earnings season, and you've got this great big splashy 30,000 people losing their jobs because it looks like this is going to be a Chapter 7 filing, straight to liquidation, as opposed to a Chapter 11 restructuring. This is going to capture a lot of Americans' attention.
So we're going to have a ton of economic data this week, Danielle. You and your team are going to be very busy. Obviously, the non-farm payroll will be a big data point. I guess I'm looking around the world. I'm seeing, some recessions around the world. I guess Germany just had a flatline quarter after a couple quarters of contraction. Are you concerned? What is your level of concern about this U.S. economy here?
Well, the U.S. economy cannot claim to exist on an island. There was a very slight uptick in Chinese official manufacturing data overnight, but that remained in contraction. I think the more notable development out of China, given that we had such great hopes for this reopening trade, is more so that we're seeing a downward movement in the services components of these PMI numbers. And that, I think, was what people paid closer attention to overnight. Gee, if it's not going to be the industrial sector out of China, then what's going to happen if the services side is slowing down? Specifically, that services one dropped to 51.5. So you're kind of on the edge of contraction in the second largest economy. And as you just pointed out, Germany is really 3 quarters into recession. We saw that the first quarter in Germany ended up being revised downward into contraction. We could see a similar bit of data coming out of Germany that revises the second quarter into contraction as well. The United States cannot isolate itself from the globality of the current recession.
Yeah, but to that end, though, the United States has existed a little bit apart from China for several years now, considering how slowly China has come back in the game post-pandemic. And the U.S. consumer remains strong. Do you think that the U.S. consumer can potentially continue to kind of power through some of this growth and offset some of the woes that we hear from around the world, despite this level of rising interest rates?
It's interesting you raise that question. Outside of the employee retention credit, which we know, I think, pumped in about $33 billion into the U.S. economy, we know much of this is fraudulent. Outside of that fiscal area of massive support going to some of the wealthier Americans, we're seeing a big uptick in the number of student loan borrowers who are preemptively getting out in front of what they know to be resumed student loan payments. And that's going to have a crimping effect on U.S. consumption. And we are indeed beginning to see that. So people are getting ahead of interest accrual beginning on September the 1st, actual payments beginning on October the 1st. I don't see an offset to that in terms of layoffs decreasing, in terms of hiring increasing. We're just not seeing enough evidence to show that there's any upward momentum going forward for the U.S. consumer.
All right, so I'm going back and I'm looking at this eco screen on the Bloomberg terminal. It is literally 2 screens full of data we're going to get this week. Danielle, can you help me focus on what I need to focus on if there's a data point out there that you're really going to pay attention to this week?
So I'm going to be looking a lot in terms of hours worked. And that really is a gauge of how tightly employees are holding on to their employers are holding on to their employees. If they're cutting back hours aggressively, trying to not push through with cutting headcount to cut costs, that's something we pay very close attention to. And again, we had Chicago PMI just out a few minutes ago. That showed that backlogs remain in contraction. I'll be looking for a similar echo out of the Dallas Fed manufacturing that hits at 1/2 this hour. We focus at QI Research so closely on backlogs because that is a gauge of future demand. If the demand is not there, if unfilled orders are not there and in fact contracting, that means that your need for employees is decreasing as a factor of time.
All right, Danielle, thank you very much. Always appreciate getting a couple of minutes of your time. Danielle DiMartino-Booth, CEO and Chief Strategist at QI Research. Busy economic week this week. All right, right now, let's get some company news with Dan Schwartzman.
Good morning, Paul. One of the nation's largest freight companies is shutting down. Yellow Corporation, which has been struggling for a long time, is filing for bankruptcy. The Teamsters Union says it was served legal notice over the weekend that the company was ceasing all operations. 30,000 people could be out of work, as a bankruptcy would be the largest in the history of the U.S. trucking industry. Just 3 years ago, the Nashville-based company took a $700 million federal pandemic loan. It has never been more challenging to find an affordable home to buy in the U.S. Bloomberg's Amy Morris with details.
High prices, a critical shortage of listings, and doubled mortgage rates are forcing countless Americans to put their next move on hold. You might feel stuck if you've outgrown your home or are looking to downsize. There's gridlock in the housing market, in part because people took advantage of historically low rates to refinance or buy with lower borrowing costs. So most people are opting to remain in their current homes, adding to an acute shortage of available properties. Amy Morris, Bloomberg Radio.
Thanks, Amy. Expect gas prices to rise again. Oil is on track to post its biggest monthly gain since early last year. Just in July, the U.S. crude benchmark has risen nearly 14% on signs the market is tightening. Some of the factors include OPEC Plus cutting back production as well as higher demand. With extreme heat hitting many parts of the country, theme park operators are finding it a challenge to attract visitors and keeping them comfortable. Parks that have water rides are directing visitors to splash zones where they can cool off. Wall Street Journal says that cave tours right now are very popular. Those are the company stories we're following this hour. I'm Dan Schwartzman, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500 set to close out a fifth month of gains today. It won't be until Friday, but all eyes are going to be at the jobs report for July. The closely watched report projected to show employers boosted payrolls by 200,000. That's a pretty healthy clip. And lots of earnings on the way, including Apple and Amazon. That comes on Thursday. That'll give us a closer look at the health of the consumer. And oil right now slightly higher, $81 a barrel for NYMEX crude, 81.26 to be exact. S&P 500 3 points higher at 45.85. The Dow Jones Industrial Average 16 points higher, 35,476 on the index. The Nasdaq 100 right now up a point at 15,754. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Steve was talking about the theme parks, trying to adapt. My favorite is the one in the Ozarks, Silver Dollar City. They have an 1880s theme in the Ozarks. Instead of any of that fancy air conditioning or indoor ride, they're just giving people balloons filled with water, and they're having water balloon fights.
Nice, I'd be down.
That sounds really fun, actually.
And Dan also mentioned, Dan Schwartzen mentioned cave tours.
Cave tours.
I did not expect to hear that today, but I can tell you, having spent a lot of time in Bowling Green, Kentucky, it's a thing. I mean, you go down and Bowling Green, for some reason, has that part of the country a ton of caves, and they're awesome to go see. And sure enough, you go down, I don't care how hot it is out, it's 68 degrees down there.
That's the basis for like geothermal cooling and heating. There's a constant temperature somewhere.
I don't know, but it was fun going down in those caves. So anyway, I get it. You know, let's go hit the cave. So if you're in Bowling Green, to my good friends down there, go try out a cave here. All right, we're going to tie all this together. We need to talk about, still got a ton of earnings. So when we get to earnings, we like to talk to smart people. We can find them. We just dial BIGO on the terminal that gets you Bloomberg Intelligence, 400 research analysts around the world covering, 2,000 companies, 130 industries.
And what they do is really incredible. They take you through from the beginning to the end of how these stories for these different companies.
Yeah, I don't know who started that business, but that person must be a genius. Here, anyway, let's bring in a couple of those smart ones. Mandeep Singh covers the tech stuff for Bloomberg Intelligence, and Poonam Goyal covers all the retail. And we're going to tie that in because retail and technology, they have collided. Think Amazon.com. All right, so Mandeep, I want to start off with, and we'll let you, I know this is news on Pat Palantir. I'm going to talk about Apple. What do I need to pay attention to from Apple's when they report numbers after the close Thursday?
Unit shipments when it comes to smartphones as well as your tablets and Macs. And look, I think expectations are low. Unlike some of the other tech companies, Apple's estimates have gone down. So in terms of expectations, they are low. I do think they're probably going to print an inline quarter, but in terms of guide, you have the iPhone 15 coming up. That is where the focus is, the holiday quarter. What could it do?
I think I might upgrade to the 15. Anurag's pushing it. Anurag Rana, another one of your tech flunkies over there at Bloomberg Intelligence, he's telling me that's a meaningful upgrade.
It is, but I guess in the context of what's going on in the tech world, the generative AI buzz,
oh boy, here we go.
It's not going to be that big of an upgrade in terms of what the phone can do. And everyone is excited about potentially upgrading the hardware for running these large language models on your phone. I don't think the iPhone 15 is going to do
doing that. All right.
I mean, I'm interested, is this part of the overall weakness that we have seen in PC demand? Is it just that your PCs last longer, or is it somehow about penny pinching and a broader consumer story at this point with Apple?
I think there was a kind of certain cadence to refresh cycle for both PCs and smartphones. That hasn't changed. Every time you have a big upgrade to hardware is when you have a new technology coming up. And I think whether it's linking your headset or being able to run generative AI on your phone, these are the type of things that can drive people to, upgrade their phones, the ones that are on the fence. Oh, my device is good enough. Do I really need a new one? And that's what drives the ASPs. So right now, everyone is talking about, even though the unit shipments is flat, how will Apple keep growing? It's the services and the ASPs, because the next version of the phones continues to get expensive and they keep layering more services.
All right, Poonam, we've got a lot of retailers set to report in the coming weeks, but let's start with Amazon. What do you expect the story to be from Amazon?
Sure, Paul. I think it's going to be a mixed breed. So we're going to see some strength online with sales growing, or I should say GMV growing in the high single-digit range, which is a good thing because since the pandemic, Amazon has dealt with having to see more moderated sales growth. And coming back to the high single digit, low double digit range just puts it on track to go back to the double digit gains that we've been used to seeing in online. But outside of that, the focus is also on AWS. And AWS sales will slow in the quarter. They're only expected to grow at a high single digit pace. And they could even moderate further in 3Q when we see their guidance, which could probably be closer to 7%.
How much does AWS just simply outweigh, however successful or not Prime Day was and the various shopping trends that we're seeing?
Yeah, so Prime Day was a huge success. We heard from Amazon the first day was its largest sales day ever. It even outpaced Black Friday and Cyber Monday last year. But when it comes to AWS, the reason AWS is so important, because it is the cash cow for Amazon, right? They produce pretty much all or nearly all of Amazon's profits. So it's really important to see those profit numbers rise. In the quarter, Amazon's AWS business will only yield about a 24% profit margin. It has historically been near 30%. We do see it coming back to that and even outpacing that as we move forward in the next few years. But for now, as that profit dwindles a little, it will pressure the overall profitability.
Mandeep, AI is certainly story number one in your world in technology. Another name today that seems to be getting the AI kind of tap on the shoulders, Palantir. What's going on there? What is Palantir and why is it up 11% today?
So with all the talk around generative AI, and Microsoft is the only one that has launched a tangible product around it. They're charging $30 Copilot.
Chat GPT?
Well, and also they're charging $30 for their Copilots.
Okay.
This is the enterprise version of the product. Chat GPT is more consumer facing. So to me, all these companies, whether it's Palantir, Snowflake, Databricks, what they're doing is essentially ingesting these large amounts of data that is being created and trying to use, generative AI or large language models to make the AI better. And that is what the play is. Now, whether or not they're successful in monetizing it, we don't know because they haven't launched a product like Microsoft has. So that is the key. If any time you see a company actually launching a product, being able to sell their customers, that's when you know this is a new deal. And that's, I think, the only tangible revenue you see right now is for Microsoft. Yes, it's further out, but at least they have a product out there. They're looking to monetize it. With Palantir, you've seen multiple expansion. Yes, this is a company that is built around data visualization and potentially could use generative AI, but we don't know if they have a product they'll be able to monetize.
But that gets an 11% move in the stock?
And that's where, everything that has happened this year is multiple expansion, no uptick in estimates. So come earnings, the expectations are sky high, and that's where you got to deliver like NVIDIA has,
Yep, that's what Doug Cass from Seabreeze Partners was saying to Tom Keene and I, and he's gotten increasingly bearish as the year's gone on because it's all multiple expansion. He hasn't seen the earnings yet. The first half of the year, he kind of understands, the most recent, 4, 5, 6 weeks, he just doesn't get. So that makes kind of some sense.
It's people looking for the long-term growth that we're not going to necessarily see immediately. But Poonam, I want to throw this to you as well, because I know you cover lots of these consumer and e-commerce companies. One of the things that we've been trying to parse here on the AI story is, do we see some of these AI upgrades roll out, for consumer benefit, for, tailoring ads that get to consumers, for getting the right products in front of them, or do we just simply see efficiency on the back end? What are you seeing from some of the brands that you cover? Because I know there are quite the lengthy list that report this week that may throw in that mention of AI in their earnings calls.
Sure. I think AI is both. It definitely will drive efficiencies on the back end, but we are seeing companies also bring it to the benefit of the consumers and the sellers. A recent example, eBay reported last week, and they launched a listing program where you can take a picture of a product that you want to sell, and AI will generate the description for you. So it removes the pain point or friction point in the selling process and also allows you to amplify your listings online. So we think that's one use case. We have Revolve reporting this week. They've used AI to help generate marketing billboards. They're using AI to help improve search. So I think there's a lot happening with AI, notably generative AI, that's really going to drive the ROI for both the buyers and the sellers.
Real quick, Mandeep, I want to talk to you about Advanced Micro Devices. It's a chip maker. Can it be a NVIDIA kind of like play?
I mean, last week we learned from Intel that PC market seems to be bottoming out in terms of inventory correction, so that's a positive sign. And look, bulk of AMD's revenue is still tied to CPUs.
Okay.
Now, what's going on with generative AI is there is a substitution phenomenon. Things that you were able to do with CPUs before, right now you're looking to do with GPUs because that's where the generative AI connection comes into play. So I do think eventually you're going to find that these companies either have to diversify their CPU kind of footprint and produce these accelerators, or I think they will be a tale of two stories, that one part is growing and the other part is declining.
All right, we'll keep an eye on all that. More earnings coming up this week and probably going into next week as well. Mandeep Singh, Poonam Goyal, they're two of the best analysts of Bloomberg Intelligence, one covering tech, one covering retail, but guess what? It's all converging. Right now, let's head down to Washington, D.C. Amy Morris has got world and national news for us.
All right, thank you, Paul. Watch for President Biden to sign an executive order limiting critical U.S. tech investments in China by mid-August, just a couple of weeks from now. Those restrictions wouldn't take effect until 2024. More than a dozen Republican presidential candidates attended Friday's Lincoln dinner in Iowa, but there's only one, former U.S. Representative Will Hurd of Texas, who directly criticized frontrunner Donald Trump.
Donald Trump is not running for president to make America great again. Donald Trump is running to stay out of prison.
Hurd's remarks were greeted with loud boos from the audience and a smattering of applause. Trump, meanwhile, has lost his bid to quash the special grand jury report in Georgia, as Atlanta is buckling up for possible indictments in connection with the 2020 election investigation. The Washington Post reporting that local, state, and federal law enforcement officials in Atlanta have been privately meeting for months to plan enhanced security measures in anticipation of that announcement. And Trump's super PAC says his legal bills are piling up now.
With the number of charges against Donald Trump in the Mar-a-Lago classified information case growing to 40, his fundraising PAC, Save America, is due to announce today it has spent $40.2 million on legal costs just in the first half of the year. The group has already begun calling back donations it has made to other action committees, and there's concern that this will really dent the spending the group can do to try to get candidates elected. In San Francisco, I'm Ed Baxter, Bloomberg Radio.
New Jersey's lieutenant governor has been hospitalized. The governor's office says she is unable to perform her duties. 71-year-old Sheila Oliver has been serving as acting governor while Phil Murphy is in Italy on a family vacation. No word yet on Oliver's illness nor her condition. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.